right, I'm going to share my desktop and start my slides. Bit of button clicking here to get everything out. And we're going to do just a really quick reminder of where we ended, which was transfers. So when you are the tuition credits, claiming tuition credits and transfers. Just a reminder, if you have tuition credits and you owe any tax, federal or provincial, you must use your tuition credits in that year. You cannot save them. You have to use what you need to get your taxes down to zero. So they have to be used up in order every year. Then, if you have any left over, you get to choose if you're going to transfer some to a parent or spouse if you have a spouse and you are a dependent spouse, parent otherwise. Grandparent is an option. We forget that you can transfer to grandparents, but it is, if you want to transfer to your grandparents, you can. Okay. Going to claim all the tuition amounts for the year on Schedule 11. If you don't fill out a Schedule 11, you're not going to get the tuition credits that you're entitled to. It's really, really frustrating for students who have missed a year or two of tax and then they have filed a later year, because what happens if you had tuition credits for a couple of years and you didn't file those returns, and then you had a couple normal years where you were using up some credits, but not all of them, what ends up happening is our adjustments get all out of order. Because tuition has to be done in order, we end up having to go back, file the old years that were missing, and then readjust all of the future years with all of the carry forwards until we are back on track. So those are really fun, time-consuming adjustments that we have to do by hand. So again, if you've been feeling at this point in the course, why aren't we just doing everything on computer? Why are we doing things by hand? Because sometimes we just have to sit there and do a bunch of things by hand. So we really need to know these forms in particular. All right, so you're going to claim any credits that you need first, and then anything left over you can transfer. We've talked about how to do the transfer on the form, but we have additional problems when we're going to transfer between provinces. So we're going to talk about that today. And there's one more thing which we didn't cover last class that I want to talk about, which is the Canada Training Credit. This is fairly new. A lot of people don't know about it yet. It's been there for a couple of years now, but it's not common enough that people have understood how it's going to affect them. So this is a new refundable tax credit for taxpayers between the ages of 26 and 65 if they are going to school. So if they're going to school in Canada is important. You do not get a refundable training credit for foreign school. But if you're going to school in Canada, you can claim a refundable credit for your tuition instead of waiting until you have income to use a non-refundable credit. So it puts a little bit more money back into your pocket in the year that you are a student. And this is to reflect the fact that for adult educators, it is generally difficult because you need to earn money for your life, and at the same time you're paying tuition. So this is to compensate for that a little bit. So there's a maximum lifetime amount of $5,000. So the most of a refundable credit you're going to get is $5,000. It accumulates at $250 per year. So the first year that you have, and it's income dependent. The first year you have, you'll get up to $250, and so on and so on and so on. That's all going to pool together to create a limit, kind of like our RSP room. Okay. What you get if you have tuition fees from Canada is the smaller of the limit you have, or 50% of the Canadian tuition that you paid. And you calculate that on a Schedule 11. So I'm going to show you what that would look like. And I do have... Oh, that's the wrong one. This is the one I want. So I'm going to get a Schedule 11 up here. And I'll make it bigger so you can see it. So on a Schedule 11, when you're putting in your tuition, you're going to put your carry forwards first. Then you're going to put the eligible tuition fees paid to Canada. Similar to transfers, you get the refundable credit on this year's tuition, not on old tuition you haven't used up yet. So it has to be on new tuition. If you're claiming the Canada Training Credit, continue by entering the amount from line 2 times 50%, look at your training limit from your notice of reassessment. So you may have been getting these and not even known you were getting them. If you filed a return last year, take a look at the bottom of your notice of assessment and see what your Canada training credit limit is. This might be important to you. You are all currently paying eligible tuition fees to a Canadian institution. If you, in this course, are between the ages of 26 and 65, this will apply to you for your tax return this year. All right, so you're going to put those two numbers, pick the smaller number, and then decide how much you want to make it refundable. You don't have to use the Canada Training Credit, but you can. Generally, a refundable credit is better than waiting to see if you need a non-refundable credit later. So go ahead and claim it if you have one. Canada Training Credit, decide how much you're going to claim, and that's going to reduce the amount of tuition that you have available to play with for the rest of your tuition forms. So it means you're going to have a smaller federal non-refundable credit and a smaller provincial non-refundable credit. But again, it's a refundable credit. It's money in your pocket whether you need non-refundable credits or not. So it is a beneficial credit. Okay, so that's how the Canada Training Credit Limit works. We're starting to see it, but you have to ask for it. If you're eligible and you don't ask for it by filling out this portion of the Schedule 11, it will not get added automatically for you. And again, you have to claim it in the year you have the tuition. So if you don't do that, then it's just going to carry forward. You're not going to go back and change your mind and say, actually, I wanted that to be refundable later. All right, into the hard bit, transferring tuition amounts. So students can transfer to a spouse, common law partner, parent, grandparent, spouse, or common law partner's parent or grandparent. We showed you the forms last time, so you know how to do that. Make sure they've used it first. I'm going to stress one more time, if you are doing transfers, for any reason, if you are transferring to a spouse, if you are transferring to a parent, if you're transferring to a grandparent, get the second page of the T2202 and fill it out and get a signature, because these get audited all the time. And most of the time, if you audit them and the student doesn't answer the request for info, or the parent who's received the transfer or spouse who's received the transfer doesn't answer the request for info, they will adjust all of the affected returns. So the student's return will get affected and have the tuition credits removed if they don't prove their tuition amount. And anyone who claimed a transfer will also have theirs removed, which means in order to fix it, we are now adjusting multiple people's returns. They get messy and they take a long time to sort out. So make sure they have it, make sure it is signed, make sure they know if they get a letter, there's a deadline and they have to do it. Fixing it after the fact is much worse than just having the information and proving it when asked. If you do the transfer to a parent or grandparent, they're going to claim it on line 32400. It's a non-refundable credit for them, and there's a similar line on the provincial return in Manitoba. So Manitoba, we have tuition credits here. We can do tuition transfers provincially as well. Not all provinces have provincial tuition amounts. So some provinces, this is not an option, but in Manitoba it is. And if it's a spouse or common law partner, we do it through the Schedule 2. So just a reminder, on your Schedule 2, we had a number of credits. Can anyone remind me in the chat window, what are some of the non-refundable credits that get transferred using a Schedule 2 from one spouse to another? Age amount is one. Excellent. What's another one? Pension income amount, disability, and we're going to add tuition to that. So if you have a spouse that you want to transfer tuition to, you're going to add it there. Karina, I'll answer that question after we get through this section. I'll talk about that. Okay. Moving expenses. Remember when we did moving expenses, I said you can claim moving expenses if you're a student, but we're going to talk about that later. We're going to talk about it now. The problem with claiming moving expenses for a student is you can only claim moving expenses against their taxable scholarship and bursary income, not other student income they have, just their scholarship and bursary income. Why is that a problem? If you have a student who is moving from one place to a different place to go to school, are they going to have taxable scholarship income? Probably not. So Helene, you've hit the nail on the head there. Most of it's not taxable. If they're a full-time student, it's not taxable. If they're a part-time student, it's probably not taxable because their scholarship is probably less than their tuition. Most of the time, they don't have taxable income to claim it against. They might. I will tell you, in all the years I've done it, I've only had it happen once, and that was because it was a postdoctoral student, and they had a scholarship. So that was my rare unicorn of a student, the rare time that I had a postdoctoral student who wasn't doing research, who had moved for their work. And in that case, we were able to claim it. Most of the time not. However, students do move and then get jobs where they move, so they might have moving expenses to claim against their employment income if they have employment income in the new place. The last thing you have to remember, students can only claim moving expenses if they've actually moved. So the first thing you do, and we did this for moving expenses, go back to that chapter and review, is determine, did they move? If they moved from one place into student housing, they didn't move. If they're living with friends, then they're not on the lease. They didn't move. They have to have established residence in the new place. Okay. Now, if they moved in with their boyfriend and they were there together for a year, now they have a common law spouse and their boyfriend is on the lease and they're not on the lease, but they have a spouse there, maybe they have moved. So it gets messy and it changes from year to year. But if you think you're going to claim moving expenses for a student, first of all, make sure they have income that you can claim it against. And second of all, make sure they did actually move. Okay, that's the easy part. One more quick note, adult basic education assistance. If you have a T4E slip with non-taxable tuition assistance, they will get a deduction because they will have it included in their EI income, but it's not taxable, so they'll get a deduction. In that case, they did not pay for their tuition, so they do not get a tuition credit because the government paid for their tuition. So that one you have to watch out for. If you have a T4E and a T2202, and the T4E shows that they didn't pay for that tuition, make sure you're not giving them the tuition credit, even though they have that receipt from the university. On the other hand, if they had taxable tuition assistance, they don't get a deduction, which means it is their income, which means they can qualify for tuition fees. So again, if you have a student and they have tuition assistance, my advice is go back to the textbook and just double check the rules on that one. When can they claim the tuition credit? When can they not? Just remember, you might have to think about it a little bit harder than the average student who just has normal tuition and no unusual income connected to that. All right. The bit that confuses everybody is interprovincial transfers and interprovincial carryforwards. So most of the cases that you're going to see in our Level 1 course are going to be students and parents living in the same province. Students and parents living in the same province or students and spouses living in the same province are not a problem because everyone has the same rules apply to them. It does get tricky if students are in a different province than the person they're transferring credits to. In that case, we have a whole set of rules, and it depends on both where the student is and where the parent is as to how much can be transferred. And this is the part where we find out that some provinces don't deal with tuition the way that we do. So most of the time, if you have a student in a different province and they're trying to transfer to someone who's in Manitoba, then the amount that they can claim has to be recalculated based on what the student could have transferred if they were a resident of the province that the transferring person is in. So you're going to do 2 Schedule 11s for that student, but the provincial side of things. Okay, so the federal is the federal. You can always transfer federal credits. The provincial one, you're going to do a provincial Schedule 11 for the student where they are for their tax return. Then you're going to do a Schedule 11, assuming that they had the same income, but they were living in the province we're transferring it to. You're going to pick that number, and that's what they're going to be allowed to transfer. Okay, except for Alberta, Saskatchewan, Ontario, Manitoba, and PEI. I know this is confusing. because you can't transfer from one province to another unless you're using that province's rules. So every province has their own rules for transfers and for provincial credits. We have to adjust when the provinces don't agree what provincial credits will be. Okay. So what you're going to do is you're going to enter on page 2 of the T2202 the amount they're designating to the parent or grandparent after you've done both Schedule 11. So if I have a student who is living in BC and they want to transfer credits to their parents who are living in Manitoba, I'm going to do that student's return in BC as I normally would, assuming they are a resident of BC, and they're going to have a BC Schedule 11. And then I'm going to take the same student and I'm going to do a Schedule 11 for Manitoba, and I'm going to see what they would be able to claim in Manitoba, and then that will be what I will designate. Okay? It's messy and it's complicated. What I do for this one, every time I have to do it, is I go back to my textbook and I look at the transfer rules and I figure it out based on what they tell me to do. Okay? It gets messier if you're in one of the other provinces. If you're in one of the other provinces, they have a different set of rules, and Manitoba is one of those provinces, so we have a different set of rules. So what I should have said for that last one is if you have a student in BC and they want to transfer to what is a place that is not one of those places, no, not Quebec. Quebec is special too. If they want to transfer it to Nunavut, you would have a Schedule 11 in Nunavut, a Schedule 11 in BC, and then the transfer would be based on the Nunavut rules. Okay? Going to have different rules for other provinces. So let's look at some of those provinces. Alberta, Saskatchewan, Ontario did a thing. So Ontario since 2018, Saskatchewan since 2018, Alberta since 2020 do not have any tuition credits. And because in that province you can't have tuition credits, you also can't transfer any tuition credits. So if you have a parent in one place and they have a child who is a student in Alberta, Saskatchewan, Ontario, there is nothing for them to transfer. They do not get any tuition credits. I'm going to show you what the Alberta form looks like because I think it's interesting to see the difference. You've all by now seen a Manitoba form. We have education and textbook amounts. We have 2 pages. We have transfers. In Alberta, if you had old tuition credits from Alberta and you're still in Alberta, you get to carry those forward and apply them until they're gone, and that's it. You don't get any new credits. You can't do any new transfers. It is the same for Saskatchewan. It is the same for Ontario. Okay, so if you're a parent and your child wants to go to medical school and you're going to be funding their education and you live in Manitoba, which provinces do you not want them to go to medical school in? Ontario, Alberta, Saskatchewan, because if they go there, you're going to pay lots and lots and lots of tuition. You will still get a federal transfer, but you're not going to get any provincial transfers for them, and they're not going to get any tuition credits provincially to carry forward for themselves either. Okay? And if you want, you can look up the Schedule 11s for every province. You're going to see they all look a little bit different. Okay? Now, transfers from Manitoba, because we have to be special as well. So what you're going to do for transfers from Manitoba is different. If the student is in a different province and they have tuition that they can transfer, so they're going to be in one of the other places, what we do in Manitoba is we calculate what they have available to transfer in their province. So we'd look at their, let's say, again, BC. We're going to look at their BC form, Schedule 11, see what they could transfer if they were there, calculate the same thing as if they were in Manitoba, and then for Manitoba, we're going to pick the smaller number, and that's what they can transfer. So the rule for Manitoba is calculated both ways, and then pick the smaller of the 2 numbers. Okay? And then we have a whole set of rules for Quebec. If you're dealing with someone in Quebec, you need a specialist for that. And Helene, we don't file both S11s. The student will file the S11 that they normally file, but they will limit the transfer to what they're allowed to limit it to. And then we file for the parent just the transfer amount, and we just keep a note in the file that says this is how we calculated it. So the student is still just filing an S11 for their province, but they have to limit how much they transfer based on these rules. because of the transferring to someone in a different province. I would say if you're a new associate and you're doing tax returns for the first time, get help when you're doing interprovincial transfers, but don't shy away from trying them. It's good to run the numbers and see what they look like because you get a sense for how this works and you can practice it. But definitely, if it seems like a lot of difficulty, get some help for these ones. Okay. So most of the other provinces, it's going to be transferred the amount that would be allowed in the province that the parents are in. In Manitoba, it's the lesser of the amount between the two provinces. If you're in Alberta, Ontario, or Saskatchewan, there is no transfer. And if the student has no transfer in the province because they have no tuition credits in their province, there is no transfer. Okay? There's a nice summary of this. Helene, if the student is not resident in the province of school, so if the student is resident in Manitoba because, let's say, they moved to Alberta, but they moved into student housing and they haven't changed their tax residency, then they're going to be a Manitoba resident. They're going to fill out a Manitoba return. They're going to get Manitoba credits, and the transfer will happen as if they were in Manitoba. So we always have to look at what is the residency for each person and then decide if these rules apply. That is a good point. Okay. PEI, you get either, and this is fun, either the amount that the student is allowed to transfer federally or the amount that they can claim for the rules of their province, whichever is smaller. So for that one, you're going to look at what the student has on their return, on their Schedule 11, and then you're going to look at their federal transfer and pick the smaller of those two numbers. And that's what they can transfer to someone in PEI. Okay. Then we have the fun one, which is carryover. So we've talked about transferring in the year you have tuition to another person. We also have the problem, what happens if you do all your school in one province and then you move to a different province and you want to use your carry forwards because you haven't needed them in the past, you had low income while you were a student, then you moved to a different province, got a really good job and have lots of income and you want to claim your tuition credits now. How does that work? Well, except for Alberta, Saskatchewan, Ontario, PEI, and Quebec, we're not going to deal with Quebec, except for those ones, what you get is not whatever you had for your provincial carry forward. So on your notice of assessment, it will say this is your federal tuition carry forward, this is your provincial tuition carry forward. For all the other provinces, you're going to ignore the provincial carry forward. You're just going to take whatever the federal number is, and that becomes the first line on your MBS 11. The federal amount and the provincial amount will match after you move. So those ones are easy. Okay, they're usually not great. So Manitoba, we tend to have higher provincial carry forwards. So if you come from a different province and then you move to Manitoba, you usually lose a few credits there. But that's the rule. If you move to a different province, take whatever the federal carry was. You just ignore what the provincial was. The number you put on the top line of your MBS 11 after you move is going to be the federal amount for that year. Okay. Alberta, Saskatchewan, Ontario, you get nothing. If you had a bunch of tuition carry forwards from your province and then you move to Alberta, Saskatchewan, Ontario, your provincial carry forward is 0. And then in PE, the provincial carryover is the lesser of the federal amount or the fun one from the previous year. So take the one from the previous year, your provincial one, look at the federal one, whatever number smaller is what you get. So think about the consequences for a student who went to school before all this started happening. So I'm thinking mostly about medical students because this affects medical students right now the most. If you want to become a doctor, you go to school for a very long time. You do an undergrad degree, probably 4 years. Then you do medical school at very high tuition, probably for 4 years. Then you do a residency, which could be between 3 and 5 years, and you pay tuition while you're doing that. Then you do a fellowship, and you pay tuition while you're doing that. Imagine going through all of that when you lived in Ontario the whole time. So that would have started, the whole process and all those big tuition credits would have started in Ontario before they stopped giving you tuition credits. So you would have some carryovers in Ontario. And then you start working, you make a lot of money because you're a doctor now, you're going to have some nice tax refunds. Think about the exact same student, but they did their education portion in Manitoba. And then they got a job as a doctor in Ontario. What's the difference for that person? What happens to their carryovers when they move from Manitoba, where they were doing school and residency, to Ontario, where they start working? They're gone. And when we're talking about credits for tuition for medical school, some medical students pay $25,000 a year for tuition. That's a lot of credits. So this has been, and we're seeing how it is affecting the incentives for people to move from one place to another after doing work. Now, it's going to even out in the end, because at the end of the day, nobody in most of the provinces are going to get tuition amounts provincially anymore, and it won't matter. But for the next couple of years, we're finding that some students who didn't know that this existed were really relying on having those tuition credits, and they're just gone. So we're going to see how this works out. That's what we have right now. Manitoba has some of the most ones. Helen, good question. Why is the provincial tuition being removed? Because it's worth a lot of money. What happened initially is the federal government used to have an education and textbook amount, and they've decided, among other things, we're going to remove the education and textbook amount. When they did that, a bunch of other governments went, hey, we can take credits away and people will let us do that. And all of those provinces looked at it and said, well, since we're changing things, this is a good year for us to take them away as well, because we're spending a lot of money doing this. And of course, the provinces that removed it entirely all promised that as a compensation for this, they were going to put more money into the education system so that tuition would be lower and schools would be cheaper. They said, we're going to save a lot of tax money doing this. We're going to use that tax money to make education cheaper for everybody. Whether or not that actually happened, we have to wait and see. I don't necessarily think that the cost of education in Ontario and Alberta has gone down as much as the lost tax credits have been, but that was the argument that they made. So really what happened is there was one small federal change and all the provinces went, hey, normally we can't take credits away, people complain, but let's do it now because we can do it now. And Brittany, you can't just make education cheaper unless you get university to drop tuition. Well, that's the problem. The idea and what was promised is we're going to give a bunch of money to the universities and make them promise to lower tuition. And we're still waiting for that to happen. But in the meantime, Alberta, Saskatchewan, Ontario are paying way less money, way smaller refunds out to lots and lots of people. They're saving a lot of money from having done this. So Manitoba did not go that route. Manitoba even elected to keep the education and textbook amount, which many places didn't. So there we go. But the students in professional education particularly are suffering for this, and more than anything else, low-income students who were going there, who were borrowing money expecting to get refunds to help them pay it back, and now are not going to have that option anymore. It's going to be difficult for them. And if we don't like it, call an MP. All right, that's students. Let's do the review problem for this chapter, which is going to be review problem 13-2. We're going to get to see how transfers work here. Bear with me while I try to drink something so I don't lose my voice completely. We have a family, Kenneth Blake, Richard Blake, Edith Blake. All right, Ken works for a local mining company as a superintendent. He is Richard's father. Ken and Edith have been divorced for some time. Ken pays Edith's spousal support $520 as long as she doesn't get married again. That's not a great contract because she might not get married forever and he'll be paying for the rest of his life, but I'm sure he'd go to court at some point over that. And he has to pay child support of $780 per month until Richard turns 25, as long as Richard is in school. That's something we see very commonly for support orders. Kenneth makes these payments every year, but he never reported them as a deduction on his TD1. So I'm not sure if you were very aware of what a TD1 is, but that's the form that you go to your employer and you say, these are all the credits I'm getting. I want you to take off the minimum tax needed, assuming that I'm going to have these credits and adjustments. Kenneth said, I'm not going to do that. I'd rather get a refund. So he's just claiming the basic amount and everything else he's not adjusting for. So his employer will take more tax off than they need to and he'll probably get a refund every year. That's what that sentence means. Okay. TD1 is the same form if you have a client who is concerned they're going to owe money, or they know they have a source of income that's not adjusting correctly, that you can ask to have more tax taken off. So you can use that form for that as well. Or if you have two employers and you know that one of them is going to max out your CPP and EI and you don't want to have big overpayments every year, you can use that form to tell the other employer, I already have an employer who's adjusting for this, please don't take off CPP or EI. So that form is really used to help coordinate how much tax your employers take off. Okay, so he's making support payments. He's not adjusting for it with his employer for his tax return. He plans to use his tax refund to invest in mutual funds and to put money into an RESP for Richard. Okay, Richard is enrolled at the university. For me, it's the University of Winnipeg. Even though he lives with his mother, he wants to transfer the tuition to Ken this year because Ken is the one funding his RESP, and Richard thanks him for his help. Richard also has a scholarship from the university. He has $1,400 of tuition carried over federally, no provincial federal carry forwards. And we have some information about Edith as well. And Edith has some installment payments. And Edith has a dental bill for Richard. Can Edith claim the bill for Richard? Richard is over 18. Yes, because she is still supporting him. He is still a dependent, and she paid for it. Which line number will she claim it on? Will it be reduced by her income or by Richard's income? 33099 or 33199? 33199. It will be reduced by his income, and she will need to file a worksheet to calculate it. That is really important to remember. We get into the habit as parents of claiming things for our children, and when they stop being children according to the tax return, we don't stop claiming them, but we have to remember they're adults now. They get handled in a different way on the tax return. Okay, so we have a T4 for Ken. We have a T3 for Ken with some capital gains and some other income. Don't forget the management fees. And we have some dividends. We have a T2202. So for this one, we know that Richard is a full-time student, 8 months, and he has a scholarship with a box 105. How much of the scholarship will be taxable? $0. Because he's a full-time student, $0. Excellent. Okay, and he has an RESP with a box 42. Box 42 is appropriate because he went to school. There will be no additional penalties. The income will belong to Richard. If he had not enrolled in school and money had come out of the RESP, that would be a problem for Ken. But in this case, he is using it for school, so box 42 is Richard's income. And then we have Edith's T4 here as well, and we have some interest income for her. As soon as you see lots of interest income, what conversation might you have with Edith? Get that money off. You might owe. Even if you don't owe, let's make it not taxable if we can. Let's see if you have a place to put it, like, oh, I don't know, a TFSA would be nice. All right, so let's take a look at the returns, and I'm actually going to show you the returns for these ones. And we're actually going to start with Richard because Richard affects the most people. So for Richard's return, he has no employment income. He has nothing on his scholarship income line. So scholarship income is blank, but he does have RESP income. So he has taxable income from his RESP. His total income is $13,450. He's in the lowest tax bracket. He gets his basic personal amount. And then we have to find out how much tuition he needs to use for himself. So we're going to take a look at his federal schedule first. Federal schedule, he has a carry forward. The carry forward is there. He has new tuition amounts of $6,400. Total available credits for this year, $7,800. He can't use the Canada Education or Canada Training Credit because he's not old enough. He's too young for that. How much does he need to use? Well, we take his income and subtract his basic personal amount, and we can see that he needs to use 0 federal credits. So he's going to claim 0 tuition credits this year. Now that I know he's going to claim 0 tuition credits, what option does he have for transfer? He can transfer the max. And he can pick who he's going to transfer it to. I am going to fill in the 8 months here. That's important for the provincial schedule. If you don't have a number in there, you won't be able to use the education amount on your provincial schedule. So that is critical because we want those textbook and education amounts provincially. He can transfer the max of $5,000. He's going to choose to transfer $5,000. He's going to transfer it to Ken, and now he's going to take a T2202. He's going to fill in Kenneth Blake, father, and on the federal transfer line, he's going to say $5,000, and he's going to sign the bottom of that piece of paper. He's going to make 2 copies. He's going to put one in his tax file, and he's going to give one to his dad. All right, his father is going to need the $5,000 on his line, so we're going to make a note of it. So we go to his return, we're going to do the transfer on his, and there's still some left over. He'll have a carry forward for next year of $2,800. But we're not done because we want to find out what we can do provincially. So provincially, no carry forward, but he does have tuition, and we're going to add the textbook and education amount. So the education amount, 8 months full-time times $400, an extra $3,200 of credits. Provincially, he gets $9,600 of credits this year, which is great. However, we only get to reduce it by his provincial credits, and we don't have high provincial credits in Manitoba, so he needs to use some of his provincial credits tuition this year. He has to use $3,514 this year. Okay? Because he has to use $3,514 this year, we're going to have to see how much is left over for him to claim. So we're going to use some of this on his provincial form. I will show you where that is in a minute. Now we're going to go down and see what can we do for the future. So he has an unused amount of $6,086. The max he can transfer is $5,000, but he had to use $3,514. So the only thing left over to transfer provincially is $1,486. This is the part where I would stop and say, okay, because I've only got Richard sitting in front of me right now. He came on his own to file. I would say, you're going to transfer to your dad. Great. What province does your dad live in? And find out if his dad lives in a different province, because if his dad lives in a different province, we might need to make some other decisions. In this case, his dad lives in Manitoba, so that is going to be the transfer. We don't have to worry about interprovincial things. So now I'm going to go back to that T2202 slip on the second page, and I'm going to fill in the provincial transfer amount, $1,486. The good news for him, he gets to carry forward the rest, so he is going to have a provincial carry forward for next year. This is very common, so you will find very frequently that students with some taxable income end up having smaller transfers provincially. We have to watch out for it in Manitoba. We get into a habit with the federal credits of transferring the max, but we have a very low personal rate in Manitoba, and it's much more common in Manitoba that we can't transfer the max here. So keep an eye out for that. All right, we're going to go back to his return. We're going to use no tuition credits federally, but on his provincial one, he is going to have to use some tuition credits, so those are going to go in here to reduce his tax owing down to $0. Okay, he is going to be entitled to a family tax benefit because his income is very low. He is going to be entitled to some provincial credits because his income is very low. When we get to the end of his tax return, you're going to see he owes $0 tax. That has to be true because there is a transfer. We know that he's paying no tax federally and no tax provincially. And he's going to get $60.50 in provincial credits as well. All right. Edith's return, going to look a little bit different. For her income, she has employment income, she has dividend income, she has support payments. What does she have to report for support payments? All of the support she received, and then the taxable portion has to show up as taxable income for her. It doesn't matter if Kenneth declares it or not. She doesn't know what he's doing on his tax return, but it is taxable income for her. $42,346.80 for her. And she does have a pension, registered pension plan deduction, CPP, and so on. I think that's basically it for her. If you did her whole return and you want to know what she got, don't forget she did pay some installments. She is getting a refund. Will she have to pay as much in installments next year? No. The tax she was supposed to pay was $6,706. She had $5,338 deducted. She's pretty close. She will not have to pay as much in installments next year. She may still have to pay a few because it overlaps by 2 years, but it won't be as big, and it is good because she's getting a refund this year, even though she's not getting any credits from her son. And then I want to really quickly show you the medical expense line. Medical expenses, she's going to have for herself $1,680 reduced by her income, and then the dental bill is not going to go on line 33099. The dental bill is going to be done on the worksheet. So I'm going to show you the worksheet. Dental clinic minus 3% of Richard's net income allows an additional $231.50. If you put them all on the same line together, you gave her too much for medical expenses. And these get audited, and they're going to ask her to pay it back. So be careful for that. That's Edith. Let's take a quick look at Kenneth and see what happens on his return. And I'm going to show you a couple of lines here. So he has a lot of income. He has some dividends. He has some capital gains. And he has some other income. The other income was from his T3. Okay. Don't forget the dividend tax credit. He did buy he did have an RPP through work. He has union dues through work. He paid support. He's going to make the support deduction. Definitely he wants the support deduction. How valuable is the deduction for him given what his income is? So if his income would have been over $98,040, right? His total income was over $98,040. How valuable is that deduction for him? $26. So definitely worth it. In fact, with these deductions, it takes his income from the third tax bracket and brings him down to the second. So that's excellent for him. Okay, he did have some carrying charges, so make sure you found those on the slip. We have enhanced CPP. He's going to get the max there. And that's it for him. Then he's going to have his personal credit. No eligible dependent amount for him. His son's not living with him. CPP, EI, Canada employment amount. And then tuition amount transferred from a child. So 32400, that's where the tuition amount is federally going to be transferred. Okay. And then provincially, I'll show you the same thing is going to happen provincially, but smaller. So provincially, he only has a transfer of $1,486 because that's all that Richard was able to transfer to him. Okay. Given all of what you've seen, do you think he's going to owe or do you think he's going to have a refund? We had a big support deduction. We had union dues. We had RPP. We had tuition transfers. Nice big refund. Very valuable deductions. He had a little bit of income added, but he had big deductions and some additional credits. And he had more tax being taken off at work because he wasn't adjusting for those big deductions. So yes, he is getting a big refund, which is what we expect. Okay, there we go. Any questions about this review problem? Okay, think we're going to take a 5-minute break there. We're going to come back. We're going to jump into Chapter 14, which is Provincial Credits and Tax Changes. Oh, Helene, Ken didn't report the payment to his employer. So Ken didn't tell his employer that he's paying big support payments and he's going to have a big deduction on his return. So his employer calculated his tax assuming that he would be in the 3rd tax bracket. So Ken knew he was going to be in the 2nd tax bracket, but his employer thought he was going to be in the 3rd tax bracket. So they took extra money off, therefore refund. Exactly. Good. Excellent. All right. Quick break. We're going to come back at 9:50 and we're going to jump into the next thing. All right. Welcome back from break. Give me a check mark. Let me know if you're back. Let's see who's here. Okay. Got a couple of people. Good. We did have a question, which was, why do we not have a class next Monday? So the original plan was that the assignment was going to be due before today, and then you would have extra time to study. So you have one class that we're skipping, which is just study time for you, and then we'd be doing the theory exam. I've pushed everything back by one class for the deadlines because you really do need time to practice and absorb, and I wanted to give you an opportunity to ask questions and really get through the answers to the degree problems. But you're still going to have that extra study time. So we don't have a class next Monday. We are back next Wednesday instead, and your assignment 2 will be due before next Wednesday. Okay. Use the time wisely. So some of it for working on your assignment, some of it for preparing for your theory exam. Questions about the theory exam I get all the time. Is it multiple choice? Yes, it is. How long is it? It's 3 hours. It's 50 questions. Multiple choice, you will have time. There are some where you have to do calculations, but you're not going to be doing a full tax return. You'll be given information. So it's similar to the questions we have in the exercises and the self-tests. So if you've been doing your self-tests, if you've been doing the exercises, you're in good shape for the theory exam as well. Okay, you get one attempt. Don't close out of it. If you open it, you have to finish it because we can't unlock them, and we won't be giving an additional extension. So you have one extra class's worth of time for your theory exam to make sure you all had an opportunity to ask questions and for us to do review. But beyond that, I can't extend it further. Okay, let's jump into the last section that we have. So I'm going to share my screen. And I'm going to start my slides. And we're going to be doing Chapter 14, which is the Provincial Supplement and the Tax Updates. You're going to notice as soon as we do this that there are some slides that are not in your slide deck, and that is because they are provincial specific and your slide deck is federal. So you will be able to get these from the recording. I'm not putting anything together that isn't already in your provincial supplement. I've just kind of summarized it so that I have something to talk about today. Most of the provincial specific things we've already done. So if you have a specific thing you want to know, go back to Chapter 5 where we talked about the big credits that we have to do. Go back to the dependent chapters. Go back to the medical expense chapters. That's where we focused on a lot of province-specific credits. Just going to hit the few we haven't done yet. So the first one that we haven't done is the fitness amount. Now, those of you who are old tax preparers will know there used to be a federal fitness amount, and fairly recently the federal fitness amount was taken away. Most provinces similarly removed their provincial fitness amounts. They mirrored what the government did. Manitoba kept it. And I will say a lot of people don't know that Manitoba kept it. So it used to be when I started doing tax returns, everyone who had children doing sports, doing hockey camps, doing physical camps, they would come in with receipts and they would say, here are my receipts for everything. Now they don't bring receipts because they think the credit is gone. Everyone knows the federal credit is gone. The companies that do these are not necessarily issuing receipts because they don't know there's still a provincial credit. So if you have someone with kids who are of an age where they're likely to be enrolled in something, ask what they're doing. Do they have any hobbies? If they have a hobby that sounds like it might cost money for the parents, you can ask them to go get receipts, come back, and get them additional credits on their tax return. The fitness amount is for children and young adults, so people under the age of 25 by the end of the year, okay? By the end of the year is important for the fitness amount. Children under 18, so if they're 17 at the end of the year, will be claimed by their parents. Children 18 to 24 by the end of the year will be claimed by themselves or their spouse. There's a maximum claim of $500 per child or young adult, and there's a special additional claim, so you get $500 credit max up to the amount of the receipt. So if you have a receipt, that's what you're going to get. If you have a disabled child or a disabled young adult and that person has a receipt of at least $100 eligible expenses, they get an additional $500 credit. So a disabled child who is doing, let's say, sledge hockey, maybe, so they might have something like that. If they spend $100 for sledge hockey and they have a receipt for $100, their fitness amount or their parent will claim a fitness amount of $600. So add $500 automatic to whatever the receipt is, but the receipt will still max out at $500. So the most they will get is $1,000. Does that make sense? I think if you practice doing it, you'll see how it works. There's really good information on the government website for how this works. You have to have something that qualifies. To know what qualifies, your best resource for that is the government website itself, but our textbook does have information as well. So if I go into the provincial supplement now, I'm going to give you an example. It has to meet certain requirements to qualify. So they have to have a certain number of weeks, a certain amount of activity. So 8 or more consecutive weeks in which substantially all the activities are a significant physical activity, or 5 or more consecutive days where 50% of the daily activities are significant physical, or things from a club. So you might have, a soccer club, things like that. And then they will tell you what is eligible and what's not. So things that are eligible is the operation of the program, instruction, basically what they put on the receipt. Things you can't claim is equipment. So if you're renting equipment, and let me tell you, again, if you have kids and they're in hockey, that's expensive. That doesn't qualify. So the cost of going to the hockey program, yes. The cost of buying all the padding and skates and helmets and hockey sticks and everything you need, no. Okay? Travel, meals, and accommodation, no. Fees are eligible in the year they're paid, not the year the activity takes place, so you have to have the paid receipt. And then they have the information there. If you want to know what kind of things count, horseback riding does. Someone went to court to get horseback riding way back when it was a federal credit. They were disallowed because they were told there wasn't a significant physical component. They went to court. The court said, actually, it is very physical to do horseback riding. So yes, it does count. All right. So things that count are all in here. Dance counts, golf counts, gymnastics, water polo, squash, anything that falls into this type of category. Things that don't count are things that are free. If you're not paying for it, it's free. If you're getting a charitable donation credit, it's not. It's charity that you're paying for. You're not paying for the activity. If they're unsupervised or not suitable for children, no. Okay. Anything that would qualify for the political contribution credit, I can't imagine something that would be a fitness thing that would qualify for the political contribution credit, but basically if you can claim it somewhere else, you have to. Okay. And then things that use motorized vehicles, snowmobiling does not count. Okay. Snowshoeing would, if you were in a snowshoeing club or your kids were in a snowshoeing club, right? And then things that are paid to a spouse, common law partner, or a person under 18. So if the person doing the training is a minor or a relative, basically. Okay. There's a special rule too. If you have something that qualifies both as childcare and as a fitness amount, you have to claim the childcare portion first. We see this most often with day camps or weekend camps. So if you have a weekend camp or a stay-away camp or you're off for a while, you have to use it as childcare first. But the excess portion, the portion that you can't claim because of the limitations for childcare, if they do qualify, can then be used for the fitness amount. So there's a priority here. If you have a sports camp receipt that qualifies as childcare, use it as childcare first. See if there's anything left over. If there's something left over, you can claim up to $500 as a fitness amount. And you have to have the receipts as are here. Okay. Any questions about the fitness amount? people don't know it's there anymore, so they've stopped bringing them in. Helene, are they audited? Yes, they are. Everything that has a receipt is audited. I wouldn't say they're audited as frequently as some of the other ones, only because they're small. It's a provincial credit only with a max of 500. Does a YMCA membership qualify? I don't remember the answer to that. I would have to look that one up. I would say it would have to specify what the activities were. So if they are in the YMCA and they are registered in certain courses and courses at that YMCA would qualify, then yes. So swimming, yes, but the receipt has to specify that it is for swimming. It's not just a membership that they can choose to use or not use. So the receipt would have to make it clear that it meets the requirements that are up here, which is how often is the program, how often is the activity. Okay. Excellent questions. These are the questions that my clients ask me, and I have to look them up. All right. We also have a children's arts amount. Again, there was a federal credit. The federal government took the credit away. Everyone stopped bringing in their receipts. If you're in Manitoba and you have a child who is involved in something that qualifies as an arts amount, put it on the return. This one is different. It's children who are under 16 at the beginning of the year. So music lessons count. I'm glad you asked. I give music lessons. I give receipts to people. I tell them to take them to their tax preparer and tell them to use it. And if their tax preparer says we can't use it, get a better tax preparer because you absolutely can use them in Manitoba. All right, so it is a maximum of 500 per child. Again, so that should just say child because young adults do not qualify here. Okay. Additional claim for 500 for a disabled child with at least 100 of eligible expenses. So it works the same way. If you have a disabled child, as long as they have $100, they get the $100 or whatever they've paid to a max of 500 plus another $500. And again, it has to go in order. So if you have a receipt that could technically qualify as child care and fitness and an arts amount, it falls under all three categories. You have to do the child care first. If there's anything left over, you can do the fitness amount. If after that there was anything left over, there won't be, but if there was, it would be the arts. I can't think of really anything that would qualify for that specific thing, except possibly a stay-away camp that's like half fitness and half sports. And Helene, yes, a disabled child gets $1,000, provided that they've had at least $500 of expenses. Ballet class, probably fitness. You'll get more as fitness than you would as arts, but that might be one where it falls under both, and maybe you could claim it under both. And again, it gets a little bit messy when we start mixing them up. If you want to know what qualifies for the children's arts amount, again, it has to be ongoing, so it has to last at least 8 consecutive weeks, or if it's a children's camp, 5 consecutive days. Has to be supervised, has to be suitable for children. It can't be part of school. So if it's an additional school program, it will not count. It has to be another organization. And it is anything promoting creative skills or expertise in artistic or cultural activities. So cultural activity, wilderness, and appreciation of the environment, all of that counts. Skills will count as well. So in some cases, it will include things like language instruction or similar things. But it'll be literary arts, visual arts, performing arts, music, media, languages, customs, and heritage. Okay. Again, what counts, what doesn't count, and what do you have to have for the receipt. Lifeguarding counts. Music, composition, theory, painting, photography, public speaking does. Scouts does if you have kids who are in Girl Guides or Scouts. Drawing, gardening for kids, tutoring counts. Voice lessons, languages, all of those things. Same types of rules. If it's free, doesn't count. If you're getting a treble nation, doesn't count. If it's unsupervised, it doesn't count. And if it's activities which could be claimed for child care, you have to claim the child care first. Anything left over, you can claim under the children's arts amount. Provincial credit only. Okay, and this one is limited to children who are 16 at the beginning of the year or younger. All right, so I usually have at this point a whole bunch of people going back to their tax returns for the last couple of years and going, oh, I had a whole bunch of receipts that I could have claimed. So One thing we're going to talk about today is adjustments. This is something you could do by adjustment if you have missed it on a previous return. All right, the messy one for Manitoba, and very, very common frequent one, is the education property tax credit. So now I want you to transfer over from non-refundable credits to refundable credits. We use Form MB479 for refundable credits. There's a big one that most people who are renting will claim, and some people who own property will claim, and that is the education property tax credit. Okay. So you've already been filling out this form, but we've only done the first page or so. We're now going to do the rest of the form. What you get is 20% of total rent paid, or sorry, that should be net school taxes, to a max of $525 for 2021. Does anyone know how much it used to be before 2021? What was the rent credit in previous years? Does anyone know? 700. Used to be 700. For a very long time, it was 700. Last year, it was 525. Next year, it's going down again. It's going to keep going down until it's gone. So in a couple of years, we won't be doing this anymore unless we have a significant change in government that changes their mind. Okay, so what's been happening is people have been giving money back to people who own property and reducing the property tax credits for people who are renting property. That's what we have right now. It is refundable, however, so that's good. It's one for family because remember the MB479 is a family refundable credit, so the family has to pick who's going to get it. There is an additional bump to this credit if the taxpayer or their spouse is over 65. The weird thing about this portion of it is it's also one credit per household. So if you have multiple people in one house and they're not in the same family, they have to decide who's going to apply. This happens especially for younger people who might be renting with friends. If you're renting with friends and you each have your own rent check or rent receipt, only one person in the house, in the address, can claim the education property tax credit. I'm going to call it the rent credit just because that's what our clients call it, and it's a lot faster to say. So when I say rent credit, I mean education property tax credit. So one rent credit per household, doesn't matter who's paying for it. So what we do in those scenarios is we tell them bring in all the receipts. So how much total was paid for that apartment for that year, that's what we're going to put on. And then you can take the refundable credit, the $525 this year, and divide it among yourselves after the fact. If multiple people at the same address claim it, nobody gets it. The government will take it away from everybody. So you do have to make sure one credit per household. Okay? And then if the household is all one family, one credit per family. Okay? I'm going to show you that, and then I'm going to talk about the last point that I have. So I want to make sure we get a look at this form because this form is important to see how it works. And I'm going to make it bigger. So we've already done the first part. We've done family income, personal tax credit. Then we get here. If you're a renter, you're going to put the address, the number of months you were at that address, the amount of rent you paid, who you shared accommodation with, because they're going to go looking to see did somebody else claim it. Because if they claimed it and you claimed it, they're going to take it away from both of you. If you have a landlord, they need the name of your landlord and then the roll number. And Helene, do you have to live in Manitoba for the whole year to qualify? No, but you have to have been renting in Manitoba. So you can only claim rent on places that are in Manitoba. So if you lived in a different place for half the year and then you moved to Manitoba and rented in Manitoba for 6 months, you're going to claim 6 months. Okay. How much rent did you pay times 20% goes here. If you're an owner who's claiming this, instead of that, you're going to put the net school taxes you paid. Okay. Most of the time, owners do not claim this because owners already get this credit in advance on their property tax bill. So most of the time, when you get your property tax bill, if you are an owner, you're going to notice at the bottom of it, there's going to be a little credit. Used to be $700. Last year was $525. If you see that credit, it means you've already gotten this. You can't get it again. But some owners don't get it automatically, especially in the year you purchase a property or the year you sell a property. So in that case, you're going to have net school taxes. If you didn't already get the credit, you're going to put net school taxes, but we don't do that very often. It's almost always there. And the credit is not on the tax bill if you're renting the property. Although if you're renting the property, you're a renter, so you shouldn't be paying the tax bill. But yes, as a landlord, you don't get the credit because as a landlord, who gets the credit? The renter gets the credit, which is the point. One credit per address. But you will get a credit for the home that you're living in, which is why it's fair. Excellent. So if you're the owner, you have to be living in it to get this. Okay. Then you're going to put the total occupancy cost. The allowable percentage is max 75%. If you are a senior or your spouse is a senior, you're going to add a basic credit of $825 reduced by your family income times 0.75%. You might get a little extra if you're low income as a senior here. And then you're going to get either $525 or whatever this amount is, whichever is more. So if you're a senior, you might get a higher rent credit than if you're not a senior. This is also relatively new, so if you've been doing these before and you're not comfortable with this area, it's a little bit different now. So there we have a little extra for seniors. Then you're going to take whatever smaller, line 25 or line 29. Okay, and then the amount you already received in advance is going to come here. So if you've already gotten the credit, it's going to wipe it back out again, and that gives you the education property tax credit. If you are someone who is receiving rent assistance, you have to report your rent assistance. Further down on here, you're going to have a place for rent assistance. Off the top of my head, I'm not going to find it right away because it's in the middle somewhere. But we will find it. There we go. Enter your rent assistance. Total rent assistance benefits received on line 61. But you also have to fill out the portion that shows you were paying rent, or they won't give you rent assistance next year. So something we need to remember for our low-income clients, even though they're not going to benefit from the rent credit, they have to fill this part of the return out as well as show the rent assistance they received, because that information goes to ensure that next year they will still qualify for the rent assistance that they are asking for. It proves that they are paying rent and that they are reporting that they have received rent assistance. So they have to do both of those things. Okay. So any questions about the rent credit? It has been very valuable. People have relied on it and expected it for years and years and years. We're starting to see it's going smaller and smaller and smaller. People who used to get refunds are starting to not get refunds because the rent credit is going away. But for the next couple of years at least, this is something we are going to do on almost every return we do. Definitely every return with a renter. There are some weird situations. And Helene, the max is $525, yes. Okay. There are some weird situations where you are both renting and owning. So if you're in a mobile home, you're paying property tax for the land, or you might be renting the land and paying property tax for the home itself, or vice versa. There are all kinds of rules for how that gets handled. And you might be in a nursing home and paying rent in a nursing home or paying rent in a retirement home. There are special rules for that as well. Make sure you review those. It's going to determine in some cases how much you can claim for medical expenses, because if you're going to claim rent for the credit, you can't claim the same rent again as a medical expense. If you're dealing with one of those scenarios, my advice is go to the textbook and read up on it. There's a lot of detail in this section, and it's quite good. Okay, so you should be doing this for everyone who is a renter. If they're an owner, ask them if they got the credit on their property tax bill. Most of them will have gotten it. We're not done yet, though, because there's an additional rebate for owners or their spouses who are 65 or older who have family income less than $63,500. And yes, Nancy, this year it is going to be less than $525. It has been $525 for 2021. It's definitely going to be lower for next year. I haven't looked up to see what it is. I'll find that out in January when I do my tax updates. All right, it's going to change a lot of our clients, so that's why I don't really want to know until we get there. We have clients who only file the returns so they can get the rent credit, and they're not going to be happy if the rent credit is not very high. All right, so we have a senior school tax rebate if you or your spouse is 65 or older and your family income is less than $63,500. What you will get is 75% of your gross school taxes, not your net, your gross, up to a maximum of $353, and then that number is reduced by 1.5% of your income over $40,000. Okay, so if that sounds complicated, the form will do it for you. Put your gross school taxes in here, times 75%, gives you a maximum, and then you're going to find your family income over $40,000 times 1.5% is going to reduce it. If there's anything left over, you get a senior school tax rebate. So one reason to put property taxes in is to get the rent credit. Sometimes, in this case, I really should call it education property tax credit, education property tax credit. But if you're an owner and you've already gotten the credit, put it in anyway if you're a senior, because you might get the senior school tax rebate. And if you don't get the senior school tax rebate, there's one more, which is the school tax credit for homeowners. So same type of rules. You have to be an owner to get it, with one asterisk on that. You have to be an owner to get it usually. You have to be 55 or older, or your spouse has to be 55 or older, and your family income has to be less than $23,750. That's a very low income for a family, but this is for someone who's very low income but is a property owner. It's a maximum of $131.25. It's reduced by 1.5% of your income over $15,000, and you have to have paid at least $160 in school tax to qualify. So if you've paid at least $160 in school tax and your income is below $23,750 and you or your spouse is over 55, then apply for this as well, and you're going to get a little bit more. If you're a tenant and you're 55 or older and your family net income is $23,750, you can also apply for this, but you have to apply directly to the Manitoba Department of Families. We don't do that one on the tax return. Okay, that's it. Those are the ones that I didn't already cover. There is a lot in the provincial supplements. I recommend you spend some time on it, not necessarily before you do the theory exam, because the theory exam is going to test federal credits. We have to make it fair across the country for everyone. But I will say, knowing your provincial credits is absolutely critical in Manitoba to do good tax returns, to come up with correct results and actually maximize what your clients are getting in Manitoba. Because we have so many credits and they interact with each other, it's really critical that you know this if you're going to be doing tax returns. And I'm going to be testing you on it when we get to the software. Because when we get to the software, you have to see what it's like to handle Manitoba credits, Manitoba dependents, and all the rules connected to that on the return. What is line 65 on the MB479? Line 65 is social assistance. So social assistance is what happens if you have a T5007. That's where you're going to put your box 14 if you're in Manitoba. And if you are receiving social assistance, you are not going to get any of the refundable credit. Or if you're on social assistance for part of the year, you're only going to get part of the refundable credits. If the fillable form is broken, you're going to have to do that part manually. But if you're not on social assistance, you could ignore it, yes. Okay. The last thing in Chapter 14, we're almost done Chapter 14, that was it. This is the shortest chapter I've done. Some tax changes for 2022. Again, the next slide that I'm going to show you is not actually in your slide deck, but the changes are in your textbook. So if you haven't looked at it yet, read your textbook. This isn't going to be 100% of the changes. These are just the ones we know about right now. There are always surprises when we see the next federal budget. So when we hit January, we find out for real what's going to happen. If you're interested in working for H&R Block and you're nervous about the fact that you've learned everything for 2021 and next year you have to do 2022, that's why we have great training. So the training we do in January and early February is, in addition to getting you ready for being in an office, it's also making sure we're all up to date on what has changed for the new tax year and we're all comfortable handling it. So we will do all of this as employees all together in another class in January to make sure we're ready to go as far as we can be. Sometimes we're still waiting in February for the forms to be released and we haven't seen what they're going to look like. That happened when we had some of the big COVID changes. So when they started putting COVID benefits in, we knew that we were going to get tax slips. We didn't know what they were going to look like because the government hadn't decided yet. Sometimes it's just very much we figured out all together as a group. But again, that's what your team is for. We have other resources. We have our block signal, which old associates like me like to call the bat signal, because it really feels like you have a client in front of you, have a question, and you just send a signal off into the ether and someone comes and rescues you. So we have the block signal for that, and we have continuing education. We have throughout the year we get updates as well, tax updates, comments, and hints and suggestions for what's coming down the pipeline and how to handle it. All right, here are the things that we know are going to be different. So indexed figures, anything that is indexed to inflation is going to change. If you want a full list of that, take a look at the textbook. It's there. These are all the numbers that I don't memorize on a tax return because they change every year. I have a rough idea of what they are, but I don't remember. And, well, some of them I remember while I'm teaching the class because we keep doing it. So basic personal credit, for example, $13,808 this year. Last year it was less. Next year it will be more. All of those figures are in our textbook now. Big changes, though. The home buyer's amount. It's been $5,000 for years and years and years. It's been $5,000 as long as I've done tax returns. Starting next year, if you buy a home, $10,000. So anyone who bought a home in 2022 will get a home buyer's amount of $10,000, not a home buyer's amount of $5,000. Similarly, if you had renovations to your home that qualify for the home accessibility expense, it's been $10,000 for years and years and years. Now it's $20,000. So that's a big, big change, and it's going to affect people who had renovations that qualify for their homes in 2022 and ongoing. Two more ones. There's a new labor mobility deduction for construction workers to allow construction workers with temporary relocation costs to claim a deduction when they don't qualify for moving expenses. I can't tell you how it's going to work because we don't know yet how it's going to work. We know that it's coming. We don't know what the form is going to look like. We don't know what's going to be eligible. We just know it's going to exist. So if you happen to be doing tax returns for construction workers next year, remember in the back of your head there might be a new credit. We'll learn more about it when we see what the budget is. So this is for people who have to move for temporary work sites, but they don't qualify for moving expenses because they haven't changed residency or they haven't moved for a new job. Okay? And again, love to tell you what it's going to look like. We're going to find that out together. And then the last one, there have been some changes to medical expenses. Up until now, it's been very limited to what can be claimed for fertility costs federally for anything related to surrogacy or for sperm donation. Those have not been allowed. They have not been on the list. They are updating the medical list when it comes to medical expenses for fertility costs. So my advice for that is the same as it was before. If you have a receipt for a medical thing and you're not sure, look it up on the list. However, if you've looked up fertility costs in the past and you think you know what's allowed and what's not allowed, they have now changed the rules for 2022 and ongoing. Okay, any questions about any of that? Not so far? All right, let's keep going. That was chapter 14. Nice and short because we put the work in throughout the year to make sure we know our provincial credits really well, because you can't do Manitoba forms without having them in advance because they affect your bottom line. So you want to make sure you get the right numbers. Do spend some time looking over your provincial supplement if you haven't done it up till now. All right, so let's take a short break. We're going to keep going, but I will put another break in, I promise. and we're going to do Chapter 15 next. So Chapter 15 is our administrative. Again, some of this is going to be review, some of this is going to be new. I'm going to go through the review part really quickly. We're going to talk about submitting tax returns, what happens when they're submitted, what happens if we don't like the results, and what are the penalties and how do you appeal, what are the time limits for all of that as well. Okay, how do you submit a tax return? You can do paper filing, or you can do e-file or net file. If you're e-filing and net filing, you don't need to send in all the documents, you just have to have them. So you will e-file all of the schedules and the worksheets, but you're going to keep your receipts. If you're paper filing, you have to include everything that you need to support it with the tax return. For those of you who've never seen a paper file, they're kind of fun. We have what's called a condensed version. So I'm going to show you what a paper file would look like for one of the clients we've done here. Let's assume, I think we're on Kenneth. If we're doing a tax return, you're going to have fillable forms that look like this, and we have 8 pages. If we're doing a paper file and you've used the computer software to generate it, for some reason you need to paper file it, we have a condensed version, which is called a T1 General Condensed. You'll see we have the same information on the first page, but then we have this barcode. That allows the CRA to scan information in without having to process it by hand. And then what they do after the second page is they just have a summary of all the numbers that they need on one page with all of their schedules. And then the very last page will look like normal, and they're going to have a signature. So when you have a paper one, the client has to sign the back page of it and make sure that they're stating that it is a real return and that they're not hiding any income. They're filing an accurate return to the best of their knowledge. What you do with this is you take the first 2 pages, then you put all of your schedules and receipts and any documentation that you need, and then you do the 3rd page, and then the last page you flip upside down and you put upside down and staple it all together in the top corner, so you have a little booklet. So that when the CRA receives the return, they can see from the first page the name of the taxpayer and their information. They flip it over and they can see the signatures there, and everything is included in the book. So that's how you do that. If you're doing it in real life, we have a really handy assembly instruction page that tells us where to mail things to and what order you have to put things in and how many things have to be signed. So if you're going to sign things, what do we have to sign as well? So this is going to give us a checklist in our software program. We do this automatically to help us assemble our paper returns. It's rare that you're going to be doing a paper return as a result of this course. So in this course, every return we teach you how to do, you can file electronically, except for old returns. So if you do have a client who has a very simple return, but you have to do 10 years of returns for them, you're going to e-file as many returns as you can, and then the older years, you're going to have to do paper. And so the older years, you're going to be doing this condensed version with signatures and documentation, and you're going to paper file all of those. I recommend when you're paper filing returns that you do them all in order and that you put a letter on top of it asking the CRA to please process them in order, because it makes life easier. So you're going to say, here's a package, please keep this together, rather than sending 6 separate envelopes and having it go to 6 different people and have them all try and handle it, especially if there's carry forwards on those old ones. If there's carry forwards on the old ones, it can delay everything. So that's how you do a paper return. If you have to send money because you owe related to that paper return, you can send a check. If you're sending a check, I very, very, very strongly recommend that you send it registered mail so that they have to sign for it, because we have definitely had circumstances where a client has mailed in a check and the CRA has lost it. If they signed for the document and they lost the check, they have to go find it. If they didn't sign for it and they lost the check, you have to prove that you sent it, and that can be really hard to do. So if you're sending money in the mail to the CRA, please make sure you send it in some format that can be tracked so that you can make it their headache if they lose it. Also, anything like a check, make sure you have a social insurance number on it so that they can connect it to the right file. Okay. Karina asked, do you have to include receipts for old paper returns? Yes. Any documentation that you put on that paper return, you have to include everything. So if you're going to claim childcare, you need T778 and you need receipts. If you're going to include medical expenses, technically you need all the receipts and you have to include all your documentation to prove it. Because they're going to be doing that return by hand, they want to see everything or they're going to disallow it. Fortunately, in this course, you're not going to do that many complicated paper returns. I get to do the complicated paper returns. That's my job. All right, so e-filing, send it electronically. I'll be showing you when we do the software what documents we need signatures on when we do e-filing, but essentially keep everything, and then if the CRA asks for it, then you send it in. All right, submitting a payment, you have to pay before April 30th or they will charge interest. You can pay electronically using My Payment, which is the online CRA program. You can call the CRA over the phone and pay over the phone. You can do online banking. You can pay by mail with a TD7R, or T7DR, sorry. The T7DR is a remittance voucher. I'm going to show you what that looks like. So you can mail it, but you have to have a remittance voucher with you when you mail it. Or you can go to the bank using a remittance voucher. Or you can set up pre-authorized debit with the CRA, but we can't do that on a tax return when we e-file. That has to be done either through net filing or manually by the taxpayer. So if they're doing a paper return, they can choose to do pre-authorized debit as well. Okay. And pre-authorized debit can be a one-time debit or it can be a multiple payment debit. This is what a remittance voucher looks like. They now have barcodes on them as well, so they're going to look a little bit different. If you are going to be using a remittance voucher, you need a personalized one. So our program will create personalized ones, which can be taken to the bank. If you have a client and we're e-filing for them, we will print them a personalized remittance voucher. They can take that to the bank and pay if they want to. Or if they want to get their own remittance voucher, if they're signed up for My Account, they can ask for a remittance voucher through My Account. It used to be we had booklets of these. We just had a stack of them in the back, and we would just pull off a remittance voucher and fill in their social insurance number. Now they have to be personalized. Okay. What happens after you file? Returns are processed in the order they're put in the queue. We have no control in what order they get into the queue. And we have no control over whether or not the CRA is going to process them efficiently or not efficiently. If anyone has been anywhere near a tax office in the last 2 weeks, you're going to hear the CRA has been really, really buggy lately. So systems are going down, AFR is not working, we can't process our CRA request for authorizations. E-filing is kind of hit and miss right now. I think they're doing some software updates, and they're not going very well. So hopefully they have that sorted out before tax season. But it does mean things are a little interesting right now. Some things are going through and some things we have to wait and resubmit. In tax season, most of the time, it's pretty effective and we don't have delays. I can say in all the years I've done it, I think there's only been 3 noticeably long periods of time where we've had the CRA down and we've had to sort of pivot a little bit for our clients as we haven't been able to work with the CRA programs, and that's not an H&R Block problem. That's an across the country. The CRA is just not working right now. But most of the time, they do their updates before tax season and after tax season. All right. If it's electronically filed, it's assigned to the queue and it's submitted. Paper files will go and undergo an initial assessment, and then they get entered into the CRA's computers. The CRA will keep paper filed returns and file them. Okay. Notices of assessment are sent once processing is complete. The CRA has review processes. They have what are called pre-assessment reviews, post-assessment reviews, and a matching program. I'm going to talk about these in the opposite order. So the matching program applies to everything when we do an electronic filing or when we do a paper filing. The return gets entered into the computer. The CRA has an automatic matching program. It will match what you've submitted to the receipts and slips they have on file. If they have a slip that doesn't match what we put and it's income related, they will very helpfully add the income on for you. What will they do if there's a slip with a deduction or a credit that you didn't report? They will ignore it. So they will add income if you've missed income and very helpfully adjust for you, but they will not fix other things that you have missed. So that's important to know. Okay. Some things with the matching program will create an e-file error that will prevent you from filing. So that would be if you have a SIN number that doesn't match, a birth date that doesn't match. If you can't verify their ID, it won't file. You'll get a warning when you try to file it that says this doesn't work. One of the other ones where that can trigger an e-file error might be if you have a different set of information for home buyer plan or lifelong learning plan requirements, or sometimes it might if you have some disability things that don't match. But those errors are rare. Most of the time, if you make an error on a tax return, it will e-file, but the CRA will adjust, and then they'll send you notice of assessment. They'll say, this is what we've changed from what you submitted and why we've changed it. So if you do get an answer back when you file a return and you notice that the result is different than you calculated, make sure you read the notice of assessment to see what it is. If it's something that is critical to the return, if it's the name of the taxpayer, if it's their birth date, if it's their SIN number, it will not file. If it's an address problem, it will not file until you fix it. So if you do file a return electronically, make sure it actually went through. Otherwise, your client thinks their tax return is filed and it isn't. Okay? That's the matching program. You can make a lot of mistakes on a tax return and it will still e-file. The CRA will fix what they want to fix out of it, and you get to fix the rest of it. Sometimes when you file a return, whether you've done anything right or wrong doesn't really matter. You will get a notice when you e-file that says your return has been selected for post-assessment review. Okay, so that might happen right away when you e-file it. It will say it's been processed for post-assessment review. It means they're not going to get their notice of assessment right away. They're going to wait until someone has physically looked at your return, and then after they've looked at your return, they may come back and ask you questions. They will process it after the fact. If you have a client who desperately needs a notice of assessment right now, or they absolutely need their refund right now, and you get a post-assessment review, you have to tell them there's going to be a delay. It doesn't mean you've done anything wrong. It doesn't mean the taxpayer has done anything wrong. It's random. It can be a little bit less random if you have a client with a history of having errors on a return or claiming things they shouldn't be claiming. They're more likely to have reviews, but it is something you have to be aware of. Sometimes it just happens. We can't control it. They just got lucky. They won the lottery. They're getting reassessed, or they're getting post-assessed. Their return will be held until a physical person looks at it. Okay. More commonly, you'll get a pre-assessment review. It's flagged because of a risk of possible noncompliance. So that's the one where they go, before we do anything with this return, we're going to look into a few things. If you have a client who's continually had problems with the CRA, they're probably going to get pre-assessment reviews frequently until they can prove that they're not doing the thing they should have been doing anymore. So a client who's had one pre-assessment review is going to have more of them probably. Okay. So post-assessment reviews, you're given time. So you file the return, they'll issue the notice of assessment, they'll issue the refund, but they're going to ask for more information. They'll give you 30 days to reply. Pre-assessment reviews, they're going to hold on to that return and wait. Okay, and they won't give it to you at all. All right. The nice thing about this, if you have a post-assessment review, that'll be a request for info. The letters are posted on the CRA. So if a client calls and they say, I got some letter and I don't know what I'm supposed to do about it, and they've lost letter and they don't bring it into you, you can go in to represent a client. You can read the letter, find out what the CRA is asking for, and you can send it electronically online. There will be a number, there will be a case number, a reference number, and you can submit it directly connected to that reference number. It's the fastest way of resolving things. Okay, now, if you've done a return and you've made a mistake, or if your client did their return on their own and then they brought it to you and said, I think I might have made a mistake, you can fix it. You can fix it by filing a T1 adjustment request. It's called a T180J. Adjustments can be made for any of the previous 10 calendar years, but you have to be careful. There are a few things you can't claim for an older year. So does anyone remember how many years back can you claim a CPP overpayment if you missed one? 4 years. Excellent. 4 years back for CPP overpayments. How many years back for EI overpayments? So CPP is 4, EI is 3. Good. So if you missed it in an old year, you can adjust it back, but if if the thing that you're adjusting back is a CPP overpayment or an EI overpayment, you can't go back 10 years for those. There are a few other credits you can't go back for. There are some provincial ones that you might be limited to how many years back you can go. So you have to be careful. But most of the time, if it's something kind of basic on a return, maybe you didn't claim union dues, you didn't know you could, maybe you didn't know you could claim childcare, and now you want to claim childcare, medical expenses that you didn't realize. So remember, I had that client who didn't know she could claim medical travel and didn't know about the refundable medical expense supplement, or refundable credit. We went back 8 years for her, so you can adjust up to 10 years back. After that, too bad. That is too old. The CRA is not going to go looking into it. Okay. The good news is if you made a mistake 10 years ago, the CRA is also probably not going to look into that. You probably got away with it. So it works both ways. You can do adjustments online for most returns for any year that you're eligible for. Some adjustments can't be done online because they change too many things or they require too much documentation. So if you want to know if you can change a particular line, the best thing to do is to go in to represent a client and see if it's an option. If that line allows you to change it, then you can do the adjustment online. If it doesn't allow a change, it will give you a warning and say this can't be done online, and then you have to do a paper adjustment. Okay. A lot more adjustments can be done online now than could be done when I started working for H&R Block. If you have supporting documentation, you can scan it and you can submit that electronically. Okay. And then finally, the CRA will not change discretionary deductions. So things you had a choice about and you just made a bad decision, they will not change. I will tell you, if the change you want is to remove a deduction or to add income, they're generally happy to let you do that. But if you go, oh, I could have claimed a higher capital cost allowance, which is like depreciation for businesses on a tax return, and I didn't, they're going to say, well, you decided not to, so that was your choice. Okay. They really don't like capital cost allowance on tax returns because people tend to get really big credits for it that maybe don't reflect reality, so they're pretty strict about capital cost allowance. We're not doing capital cost allowance in this course. Okay. Remember, for elections, you can ask to adjust, but they don't have to because it was an election. What are some of the elections you've learned in this class? We've learned a few of them. One of them was in the pension chapter. What can we choose to do in the pension chapter that we don't have to do? We can do pension split. Pension split is an election. If you want to change the election you made in a previous year, you can do an adjustment and ask them to, but you have to understand they might not do it. Good. What's another election? I'm thinking more in terms of what happens with property now. T2091. Principal residence. You can elect to declare something principal residence. If you don't do it, they don't have to let you do it. We're going to talk in a couple of slides about penalties. So they might go, yes, you can do it, but because you were very late, we're going to charge you a penalty for that. Okay, so that's an election where they may not let you change it. They probably will let you do it, but probably with a penalty attached to it. Okay, and then I had another one, elections, we know amounts that you want to pay to home buyer plan or lifelong learning plan. Those are choices. They might allow you to adjust them, but they don't have to. Okay. Doesn't hurt to ask, but we don't promise our clients that adjustments are going to go through exactly the way we hope they will. We just try our best. And Saskia, first-time home buyer, if you're splitting things different ways and you want to change it, you can ask them to, but remember, they don't have to let you. They probably will. In most cases, they do in those ones because there's no difference to them whether they give the credit to you or to somebody else. All right, how do you do a T1 adjustment? If you do it online, you go in to represent a client, or if you're the client themselves and you want to do your own, you go into My Account. You go to your tax returns and you're going to find a button that says change my return. And then you're going to change your return. So you're going to put in the lines that you want to change, the old number, the new number, and then you're going to submit it, and then you're going to send any documents you want to send, and you're going to wait to see what happens. If you're doing a paper return, and there are still reasons why we would do paper adjustments, you're going to do a T1 adjustment on paper with 4 sections. There's an identification section, an authorization section, adjustment details, and then certification. And I'm going to show you what that looks like now, because I have one here. So this is a T1 adjustment. I do lots of these. You're going to fill in the social insurance number, which tax year you're adjusting, because you can adjust multiple tax years. You don't necessarily only have to adjust this tax year. The full name of the client, if their address is the same as the last return they filed or is different. If it's different and they've moved, make sure that the information for the adjustment goes back to the new address. The authorization is going to be important if the person doing the adjustment is the tax professional and not the client. So when I do adjustments for my clients, I don't always have to get them to come in and sign them. I can sign the adjustment myself as the authorized person, and the CRA will accept it. So if I have authorization, I need my rep ID and my e-file number, and then I'm going to say that they already have an authorization on file. They've already authorized me to do things related to their return. And then at the bottom, it would be the representative signature if I'm representing them for the adjustment, or the taxpayer signature. For me, if it's a really big adjustment and it has to do with really personal things like elder dependent or disability transfers, I usually get the taxpayer to sign those. The CRA likes to see that the person actually does want the really, really big change. If it's something really straightforward, I'm just adding some union dues, I'm just correcting an RSP deduction, there's no reason to get the taxpayer to come physically into my office and sign it. I just need their permission to do it. They've asked me to do it. I work on it, and I can sign it myself. Okay? And then you're going to put the adjustment details. You need the line number from the return or the schedule, the name of that line to make sure that you pick the right line number, the old amount, the new amount, and then in the middle you're going to say how much it changed. Did it go up or down, plus or minus, by how much? Remember, you have to ask for everything you want on this form. So if you want to change something and it's supposed to change like multiple lines on the return, you need multiple lines that are changing here. You can't just trigger one change and hope the CRA will adjust it. Again, they will adjust what you ask for, and they will add income if they think you need to add income. They will correct your result. So they will you don't have to put in how much the refund is going to change or how much the balance owing is going to change. They'll calculate that. But anything else you want, make sure you have a line. What I do in the office is I will have the old notice of assessment that they had on file. I will print a new copy of the summary of the tax return, and then I look at both of them and I circle every line that changes, and I decide out of those lines which ones have to go on my T1 adjustment to make sure I'm not missing anything. Don't forget, if you're adjusting federal things, you might equally want to adjust provincial things. If it's a discretionary credit, it's not income related, make sure you ask to change the provincial side as well as the federal side. And then you're going to have details. Details is, this is what you have to do. And Saskia, excellent question. Do you have to do a separate adjustment for each year? Yes. If you are adjusting multiple years, you need multiple T1 adjustments, one per year. Okay? So other details, you're going to say, please be nice to the CRA. Just say please. Please adjust the return to do the following things for the following reason. Here are all the documents I have included with me. Thank you. That's what you put for details. Say please, say thank you. The adjusters get to know you when you work in an office for a long time. I have a few people at the CRA adjustment who are very happy to see my files because I have everything they need, and they know if they call me, I'm going to be nice to them. So then if I have a really urgent situation and they're assigned to one of my files, they're probably going to be a little bit nicer to me because I'm not making their life difficult. These are real people receiving these. Be nice. All right, so we then have our T1 adjustment request. You're going to package it all together, get signatures. In our office, if we're doing a paper adjustment, it's one copy for the office, one copy for the client, and one copy goes to the CRA, so 3 copies for everything. send it off, and then wait for an answer. There is a method where you have done a return and it's a simple error. Instead of doing an adjustment, you can do a refile, which is you just send the tax return again. Normally, once you file a tax return, you can't file another return for that year. It's not an option. You're blocked from doing that. There's a process called refile that will allow you to do that for returns 2018 and later. We don't, however, do that in our office. So at H&R Block, we never do refile. We're not set up to do it for various reasons. T1 adjustments are for anything that can't be done by refile. But if you have a client who has net filed and they've immediately made a mistake and said, oh, there's that one thing that I have to fix, they may have the option of doing refile. Beyond that, if you're interested, read the textbook about it. Again, simply, it's just not something that we do. If we start doing it, we'll have training on how to do it. All right. When should you do electronic adjustments? If it's straightforward and you have the documentation you need, go ahead and do an electronic request. It is almost always processed faster than mail, if only because when you mail it, you have to wait for it to get to them. So you're going to have the time it is in Canada Post and the time that it's being sorted at the mailing office, or at the mail receiving office at the CRA. Okay, so if it's an urgent request and you can, you're going to file it electronically. If it's a super, super complicated request involving multiple returns or multiple years that require carry forwards, it might be better to do paper, only because when you do it electronically, each year will be assigned to somebody. And if you need them all assigned to one person, because they're so interconnected that they're going to not understand what you're doing if you do it the other way, in that case, I would still do paper returns for those. So again, if I'm doing one with a lot of really messy carry forwards, lots of tuition carry forwards with transfers to different parents, if I'm doing disability transfers for multiple years to different parents or people who otherwise weren't eligible, but now we have documentation that says they are. If I'm changing something that changes multiple years of pension split with complicated donations or lots and lots of other things that I have to explain, I will do those ones by paper still. They're going to take just as long because they're difficult, and I want to make sure that they get done in a single unit in order. So those ones I'll do by paper. But I will say I do a lot of returns electronically now because they are so fast. Now, when I say they're so fast, if I had been telling you this 2 weeks ago, I would have said with the CRA, even electronic adjustments are taking a really long time because they don't have staff. They now have, and this is part of the updates that I think are kind of breaking the system right now, they now have an express adjustment system for electronic adjustments that meet their criteria. We don't know what their criteria are yet, but we know they have it. I know this because I went in the office to do an urgent adjustment request for a client last Thursday, and the client really needed the adjustment to be processed quickly. I didn't know how fast it was going to get done, and I had to warn them it might not be very fast. I was very careful to include every piece of documentation I could think of, plus a letter explaining what I was doing because it was a little bit of a messy one. But I did do it electronically. And the client actually contacted me yesterday and told me they were completely shocked. The notice of reassessment has been issued and the adjustment has already gone through. It's literally the fastest adjustment that I've seen since the pandemic started. And it had a little note on it saying express readjustment. So they do have a new system where they're trying to speed this up. That won't happen for the paper ones. So if you have the option of doing it electronically and you have everything you need, do it that way. Now, don't send an adjustment without everything you need because it's just going to slow things down. If the CRA sees your adjustment request and they're missing documentation, they're going to write a letter saying, send us the documentation. You have 30 days to reply. Then you're going to reply. Then they have to get around to reading it. It's going to delay things. If you're doing an adjustment, include everything that you can, everything they need so that they'll look at it and go, yes, I can agree to this, and just do what you want. All right. You must complete a T1 80J on paper before you do it online because you want to make sure you know which numbers have to change. And you have to make sure you know which forms and which documentation and receipts you need. Okay. Almost done. for this section. If you're adjusting multiple years, you have to do all the years at once. As soon as you file an adjustment request, that taxpayer cannot file a new adjustment request until the old one is processed. So if you want to change 3 years, change all 3 years in one submission. Otherwise, you're going to change 1 year, wait until they get around to fixing it, then you're going to send another one, wait until they get around to fixing it, and then send the third one. So anything you want to adjust, do it all at once. No additional requests will be processed until they finish the first one. And then you have a submit documents feature. If you're doing electronic ones, do them online. All right, we're going to take a break there. We're going to take a nice 5-minute break, then we're going to do a little adjustment activity, finish this chapter and do the review problem, and then we're finished the theory for the course. So let's pause, let's come back at 11:01. All right, welcome back. Give me an emoticon, let me know how you're feeling about this chapter. Hopefully I'm going to see lots of happy, relieved faces because we are so close to being finished. All right, I think Marisa agrees with me. This one is not the most stressful chapter we've done, and it should feel a little bit celebratory as well. You're going, we are at the end, we've done the returns, we know what we need to know. Now we're just going to fix mistakes. If we have to fix mistakes, how do we do that? And then we're going to wrap things up. And I think you're all going to look forward to starting on the software, which is what we will be doing next. All right, I'm going to do a quick activity here just to see how you're thinking about adjustments. So I have Amelia. Amelia forgot to designate her RSP receipt for $1,200 as a repayment of her home buyer's plan. She had a required repayment of $1,200, which was added to income. She wants to fix it. Which forms and which documents does she need to attach to her T1 adjustment? So what proof or what forms does she have to send in this case? Okay, Schedule 7. What else? She wants to claim something based on an RSP. She needs the RSP receipt. So we're going to do both. If she had multiple RSP receipts, I want all of them. This is something that a lot of people make a mistake on. So you will have a client who will have, let's say they had I'm going to do union dues because union dues happens all the time. They had union dues of $400 based on 2 receipts. They had a T4 with a union due, and they had another T4 with different union dues, and they missed one. What people will do if they're not being careful, they will send in the adjustment and they'll send in the T4 that was missed. What the CRA will do is look at that and go, oh, well, you claimed union, let's say one was 300 and one was 100. They put the 300 on, they missed the 100. File an adjustment saying, I want to increase my union dues to 400. Here's a receipt. The receipt says $100 on it. The CRA goes, oh, you have union dues of 100. I'll give you union dues of 100. You have to send everything. So if you want to claim an adjustment and it deals with a figure that's a combination of things, you have to send them all in, even if they already have them. Remember, these are T4s. They have the T4s. Think of the person doing the adjustment as sitting in a little box with access to nothing except what you show them. Show them everything they need. So if she had multiple RSP receipts and she missed one, don't just show the one they missed. Show everything. These are all of the RSP receipts, and this is what I want you to do with them. I know it seems crazy, but it's the #1 mistake that I see associates do on adjustments that just aren't going through because they'll say, we need to see that donation. They'll give them one donation. Then they'll disallow all the ones they haven't seen yet because they haven't seen them yet. And then we have to send another one and another one. And it's a lot easier for the client. Give them everything. So all the RSP receipts she has for the year, we're going to send, and we're going to send a corrected Schedule 7. Now, the next one, you might want to pull up a tax return for, or we can just, if you don't want to give me a line number, just give me the name of it. But what I would like to know is which lines should she ask the CRA to adjust? So if we want to adjust and correct the mistake she made, which lines does she need to ask for? So we're going to ask for an adjustment to which things? We're going to change the RSP deduction. She got a deduction, but she didn't want it to be a deduction, so we're going to change 20700. What else are we going to change? Schedule 7. So we're going to designate the repayment on the Schedule 7, change that line number, change the RSP deduction, but I'm not done yet. If I send this in, the CRA will very happily take away her deduction and turn it into a repayment. What other line should we be thinking of? What happened initially on her return when she didn't repay the home buyer plan? She had income. If I want them to adjust the income line, I have to ask them to. They will not voluntarily do it. They'll take the deduction away if you ask them to take the deduction away, but they won't take the income off if you don't ask them. So this would be a 3-line adjustment on my T180G. And that's why my advice is what you're going to do is redo the return correctly, sit it down on a desk in front of you next to the old return, and highlight every line that changes so you don't miss one like this. What would happen in this case, because we've seen things like this happen, someone who's not very confident in adjustments would file the adjustment, just correcting the deduction portion. The CRA would adjust it. Now they say she owes money. She's like, why do I owe money? I shouldn't have to owe money because of this. It should have been really straightforward. And then we have to do another adjustment and ask again to reduce the income. So ask for everything you want. All right. If you do get adjusted, so if you file a return and the CRA disagrees with you, or you file an adjustment and they see it and CRA says no, you have an option to do a notice of objection. So you can say, I think this is right. The adjustment office says, I disagree with you for whatever reason. If you still think they're wrong, you can file a notice of objection up to the later of 1 year from the due date of the return or 90 days from the mailing of the notice of assessment, whichever date is later. Or if you're objecting to a reassessment, it's 90 days from the mailing of the reassessment. Okay? If you miss that deadline, you cannot file a notice of objection. They are not generous about those deadlines. I have had clients who are 1 day late, and they've said, we are rejecting your notice of objection because you did not file within the time limit, even if they had a good reason. So those deadlines you have to be very careful of. If you have a client, they're not happy with the results, remember that the clock is ticking, calculate the deadline, make sure you get your notice of objection in early. Okay? You can do notices of objection online. You can submit all your supporting documentation and your explanation, and it will go there. If you're lucky, they'll look at it and go, I agree with you. Sometimes when you're dealing with a really messy tax situation, the people in the adjustments department are not as experienced. The people in the notice of objection department are more experienced. So I've had a few times where we've tried to do an adjustment. It's been disallowed. We're confident that it should have been allowed. We go to notice of objection and we get it fixed. All right. If at the end of the day you've exhausted all of your options and you're still not happy, your next recourse is to go to court. You can go to the tax court of Canada or federal court and then try again. And there are definitely people in the country who have done that. It is expensive. All right. If you go to tax court and you win, the CRA can appeal. And if people appeal, then you get to the appeals court. And if there's another appeal after that, it can go as far as the Supreme Court. So there are tax law cases that make it all the way up to the Supreme Court. Oh, Marisa, you had a husband who went to tax court and lost. Yeah, and it is expensive, unfortunately. Now, remember, legal fees for objecting to tax things, you might get a deduction for that on a tax return. If you're not sure, read the textbook section on legal expenses that can be deducted. But it is expensive and time-consuming and frustrating. So we want to exhaust every resource we can. Try an adjustment first, and then if you try an adjustment and that doesn't work, notice of objection may be the place to go. If that doesn't work, you're kind of out of options after that. Tax court if you can afford it, or if you're comfortable representing yourself. All right. If the CRA owes you a refund because you filed and they didn't give you money you were supposed to have, they will pay interest on refunds starting 31st day after the return is due or the 31st day after the return is filed. Okay. If there's an erroneous overpayment of tax, it's from the date the tax was overpaid. What do you have to do if your client has received CRA interest? They get a notice of assessment or a reassessment, and it says, this is how much your CRA interest was. Next year, you have to claim it as income. So the clients that I had where we did the adjustment on Thursday and it went through yesterday, they had on their reassessment, one of them had some CRA refund interest. The first thing that I did was highlight that, stick it in my file with some notes going, when I do their return next year, I need to remember to claim that because I'm the one who created a refund interest for them. Okay? Remember, the CRA knows about it. They're not going to get a tax slip for it. It's already on the notice of assessment or the notice of reassessment. Good. Interest that you have to pay to the CRA. They start charging interest the first day after the filing deadline for anything you owe. So if you file a late return but you didn't owe money, you don't have to worry about interest. But if you did owe money and you're late, then you do have interest. Or if you filed it on time but you didn't pay and you're late paying, you're going to have some interest. This is true for self-employed people. Even if they don't have to file their return until June 15th, they have to pay by April 30th. You remember that from the very first class. This is just a refresher. For most people, it's May 1st. Depending on when the weekend falls, it might be May 3rd. Okay? Interest amounts, if you're curious about them, you can look them up on their website. They have a set amount per quarter, so they calculate what the interest is going to be, and we have no control over that. If you're very late and you have a large amount, you can ask for a payment plan. They will allow you to do a payment plan, but they're not going to stop charging interest just because you're paying on the payment plan. The interest will continue to accrue until it's all paid off. All right, and there are penalties. If you are late filing your return and you owe money, the penalty is 5% of the balance owing plus 1% of the balance owing for every month that you're late to a maximum of 12 months. But the maximum penalty is 17%, okay, plus interest, because they charge interest on that as well. However, if you're late multiple years, if you keep not filing when you owe money to the CRA, they get a little annoyed with you, and they say, well, now the penalty is up. Now it's 10% of the balance owing, plus 2% for every month you're late for a maximum of 20 months. The penalty can be as high as 50% of what you owed again. So those penalties really, really, really stack up. If you have clients who are perpetually filing late and they perpetually owe, you need to warn them the consequences for them being late is higher than the consequences for the average person who's just missed one return. We don't calculate the penalties for our clients. We might estimate them to give them a heads up of what it's going to be, but the penalty that the CRA determines is the penalty. All right, then there's another penalty if you are caught continually not reporting income. So if you fail to include income of $500 or more on your tax return, and you've done that in any of the 3 preceding years, there's going to be another penalty on top of that. This is not super common for the clients we have except in one area, and that is repayments of homebuyer plan on lifelong learning plans. Some of our clients who didn't know that they had to do this and have been filing wrong, those repayments, if they're more than $500 and they haven't been buying RSPs, that's income that they haven't been reporting. So we do run into scenarios where we have clients who have filed incorrectly and haven't been doing their repayments, and it's been multiple years. We have to warn them that this penalty is likely to apply to them as well. Other people that this will apply to are those clients who have tips that they have been hiding and not reporting, or the clients who have interest from other sources, interest from other countries, or interest from other assets. Maybe they have that mortgage interest. If they were trying to get away with not claiming it, or if it's interest from things that don't issue slips. Maybe they have a lot of bank accounts, and all of those bank accounts have just enough money that they're not getting tax slips for it. If that totals to $500 or more in multiple years, they can run into some penalties there as well. So you, as a taxpayer, have the obligation of investigating your clients before you file the return and make sure you're not missing any income, because the consequences of missing income can get expensive for your clients. All right, what is the penalty? The lesser of 10% of the unreported amount of income, or 50% of the difference between the understated tax related to the unreported income and the tax withheld related to the unreported income. Again, we don't calculate this. We just let our clients know there is a penalty. You're probably going to have an additional penalty. And your province may have a penalty as well. So if you're going to have the penalty federally, you're probably going to have the same penalty provincially. So mostly what I'm going to say is file accurate returns and give good client interviews. If you have a client interview, be thorough, ask about things, because your job is to know more about tax than your client does. They may not know that they have income they should be reporting. Okay, now, if you know you're going to have penalties because you didn't do something and you want to fix it, and it's old, you have the choice of filing under the Voluntary Disclosure Program. This program has changed since I started working here. There has been one big change to it from a few years ago. I'm going to teach you what the system is now because that's what we have. Okay? You can apply under the Voluntary Disclosure Program if there's at least one penalty, so that means a late filing penalty or an underreported income penalty, either one of those. Okay? If you have initiated this before they caught you, if you have a letter asking you to file an old return because you owe, you can't do voluntary disclosure. They already know that you should have filed that return, and you're going to have a penalty. We can't fix that. But if you have a client who hasn't filed and you know they're going to owe, and it's an old return, and they haven't been asked to file it yet, tell them, look, let's get this done now. You're going to owe some tax, but we can use the Voluntary Disclosure Program and try to reduce those penalties. So if they haven't had a request that says file it, or request that says tell us about your income that we think you have, in that case, if you haven't been caught before they catch you, you can use the Voluntary Disclosure Program. You have to be complete. So whatever you disclose, you have to disclose everything. If you're missing 3 or 4 tax years and you want to do voluntary disclosure, you have to catch up your tax files for all of the years. You can't just file the 1 year that you're worried about the penalty for and hope they don't notice the rest. Okay, you have to make sure whatever you're filing is going to bring you back into good standing with the CRA. And it has to be at least a year old. The CRA gets 1 year to catch you. So if you have a return from last year that's now old, you have to wait. But if it's more than a year old and you haven't been caught yet, then we can use voluntary disclosure and file that old return and ask them to waive some penalties. Okay? If you're filing, you're going to need a form called an RC-199. Okay, they look like complicated forms because they are complicated forms. These apply for everyone, so not just individual taxpayers, which are the people you're going to do returns for, also true for employers, for corporations, for people with partnerships, for trusts, for people who have GST registration. This is the form you use if you haven't done anything. So the nice bit is you're going to tick off individual, fill in their personal information, and that's it. But if I was doing this, I might have a client who needs to file GST returns and they haven't, so that they're going to be a GST registrant. I might have a corporation. I might have a client who's an employer and needs to do payroll. They need to catch up their payroll forms. This is used for everything. Okay? You put the taxpayer's mailing address and the representative of the authorized person. I will tell you, as a general practice, I will not sign these ones. I can, but I don't, because they require statements that I can't necessarily verify myself. The person has to explain why they were late and why they didn't file. So I want that to come from the taxpayer. So I make sure the taxpayers sign it. I'm going to put your letter of authorization. You have to tell them the description of the circumstances and facts. So when did you become aware of the error or omission? When did you become aware that there was a problem? Why was there a problem? And what are you planning to do to fix it? Now, the more information you put here, the better, but don't lie. So, you know, I had a client where they had a really significant situation that happened in their family. There was an adult who worked in a job where they never took enough tax off, and he owed tax every single year. Unfortunately, this particular adult was in a really bad injury, and they ended up having just a whole bunch of disabilities, including some brain damage, and they were no longer able to care for themselves. They had to be placed in a residential facility where they had some assistance for living, and they had a family member who was named to take care of them for their sort of financial needs and all of that. This family member found out that they had not filed multiple years and that they owed multiple years. The problem is that the taxpayer no longer had any good sources of income. They were on a very fixed income, whatever was left from disability and pension, and they had really, really, really high medical expenses and living costs. So there was no way they were going to be able to pay all the taxes owing. The taxpayer's relative, who is now power of attorney for them, came to me and said, what do I do? We found out that that taxpayer had never been asked to file the old returns. We were able to do voluntary disclosure and say, look, here's the scenario. He's doing the best he can for his relative. He's trying to make everything right, but his relative is never going to be able to pay. So please waive the penalties and as much of the interest as you can, and we're going to organize a payment plan for the rest based on the income he needs to live on because of all these medical expenses. The reality is he's never going to pay off that tax debt, but they're paying as much as they can. That's what voluntary disclosure is for. So we put some details in on that. If the reason you didn't do it is because I didn't think that you needed to report this, say that. I was not aware of the scenario. Don't create a scenario, but give the information. So again, I did voluntary disclosure for a client. She was a student. She had never owed tax before in her life. She was in education. When she started working, she ended up working as a substitute teacher in a couple of scenarios first before she got a full-time job. For those couple of years, she didn't get around to filing her taxes because she didn't think she needed to. She'd never had a reason to file much before. She was always getting refunds. However, as a substitute teacher, she was not being paid as an employee. She was being paid as an independent contractor, and she had to file business returns, and there had been no tax deducted. So she finally got her first full-time job. She settled in an apartment. Her life is getting on track. She says, I want to catch up on my returns. Comes in to file. She's expecting that she's going to get refunds for all the years, and I have to tell her, actually, for the last 3 years, you have owed tax. And now if you file the returns, you're going to have penalties for being late and interest as well. She had no idea that that was how she was being paid or what that was going to mean on her tax return. So that's what we said. We said, here's the scenario. She didn't mean to. She was moving while she was looking for work. She had to move several times. She hadn't found a full-time job. Now she has a full-time job. She'd like to catch it up. Please don't charge her the penalties. Please waive some of the interest for her, and she's willing to pay the rest. And they did. They said, sure, that's what the voluntary disclosure program is for. All right, so you're going to fill out this section. You have to make sure that it is at least 1 year old. Now, if it's very old, you can claim all the years up till now. So if I have a client who didn't file and owed in 2017, 2018, 2019, 2020, and 2021, I can include 2021 and ask them to waive penalties and interest for that year as well, because it's part of the whole package. But if the only year they're late for is 2021, I can't do voluntary disclosure for that year because it's not old enough. I have to wait. Okay? So it has to be at least an old year in the package, and then you're going to file everything up to current. And then there has to be a penalty. If there's no penalty, you can't do voluntary disclosure. It has to be voluntary, so they can't have asked you. You can't have enforcement action coming against you already. You can't be being sued over it, any of those things. Okay? Has to be complete, and they ask you to make payment now. So you're still going to have to pay the tax. Voluntary disclosure does not waive the tax you owe. What you should do, and is best to do if you want to get your voluntary disclosure program approved, is pay the tax owing now. You can pay online, you can show the receipt, you can pay by check, attach it to the form, or pay through the bank, attach a receipt. If you can't, and I have clients who can't, they cannot pay all of it up front, you're going to say, no, it's not, but I would like a payment arrangement, and this is what I'm willing to pay. So you can fill it in there as well. And again, I recommend making at least some payment in good faith if your client can afford to. It is better because it shows them that you are actually trying to correct your tax file. Okay? And then you're going to say what's happened. So you're going to skip the GST section because you're not going to do GST returns. You're going to be dealing mostly with domestic income. What type of return? Are you filing an adjustment or are you filing an actual year? So is it a personal return or an adjustment? Which year? How much income is on that year's return? What's the total income on that year's return? How much net tax is owing on that return? Total it together. and then a detailed explanation of any credits or expenses being claimed. You need all your receipts and documentation. All of these returns have to be paper returns. If you e-file the return, we cannot waive any of the penalties and interest. If you're doing voluntary disclosure, you're doing paper returns, and they're going to a separate office. They go to a different place. They go to the voluntary disclosure office, which is in Shawinigan, because of Jean Chrétien. If you remember Jean Chrétien, he's from Shawinigan. They put the voluntary disclosure program there. All right, so everything will be paper. Everything will be delayed until they get around to it. So you need to know that as well. If you have a client who needs results quickly, this is not an option for them. If they can wait to get it sorted out, this is where you're going to send it. You might have some foreign income that they didn't disclose, so maybe that they didn't know that they had to report their foreign rental income or their foreign bank account interest or their foreign stocks that are held in a different company or their cryptocurrency wallet that's held in the U.S. If that's the case, you're going to fill in the foreign income section, A, B, and C, and then a detailed explanation if you're claiming credits against it. And then they have a declaration where they have to say, I understand this is my last option. If I do this, I am willing to accept whatever you say, and I am not saying anything that isn't true. That would be very bad, so it's very, very serious. This is why I get my taxpayers to sign it. You can sign it on their behalf, so if it's something you're comfortable signing, you can do that. But as I say, generally, if I'm doing voluntary disclosure, it's a complicated scenario, and I feel better making sure that the person signing that declaration is the taxpayer themselves. Package everything up, all your returns in paper, all your receipts, all your schedules, everything with this, and I usually do a letter plus proof of payment if you have it, and you're going to send it to Shawinigan. They can waive all the penalties if they want to. They don't have to, but they can, and up to 50% of the interest. That's the most that they will ever waive under voluntary disclosure now if you fall under the general program. There is a limited program, which is a disclosure of major noncompliance, where they will waive gross negligence penalties. That's not going to be our clients. That's going to be the big companies who have done a thing and they think they're not going to get away with it. Limited program means you still have to pay all the penalties and all the interest. They're just not going to prosecute you in court. Okay, that's what the limited program is for. Our clients will fall under the general program. Are there any questions about the voluntary disclosure program? Okay, it is useful. It is time consuming to do, but for some clients, it can save them quite a bit of money. It is a slow process. I have some that I filed last year, and we're still waiting for the answer. We got the notice saying that they're being looked at, but they haven't issued a decision yet. But then again, I have some that I did a year and a half ago that went through fairly quickly, so it kind of depends on how complicated they are as well. All right, if none of that works, if you don't qualify for the voluntary disclosure program, but you can't pay penalties and interest, you can file under taxpayer relief provisions. I am going to say it's really hard to get this. So if you were prevented from filing or responding on time because of an extraordinary circumstance, or because of disruption in CRA services, then you can ask for taxpayer relief. Now, disruption in CRA services usually doesn't affect just one client. So we had a year where the CRA was down for a solid 2 weeks in the middle of tax season. And what they did, instead of having everyone go through taxpayer relief, they just extended the deadline for filing by 2 weeks. So we all had more time, and they didn't start charging interest until the 2 weeks had passed. So they just extended the tax season, which is more likely to happen. But if a taxpayer was prevented for a personal reason, they can ask for taxpayer relief. Or if the reason they have a penalty is because of a written response from the CRA or errors in the publications. Now remember, it is very rare that the CRA will give you an opinion in writing. If they give you an opinion over the phone, and you've asked for their advice and you take their advice, and then they assess you and say that advice was wrong, too bad. You relied on their advice, but it wasn't in writing. Taxpayer relief does not apply. Okay? Or if the interest or penalty was due to the CRA's error, you can say, look, you made the mistake. Don't charge me the penalties and interest because of your mistake. Again, it's uncommon that that's going to happen. So taxpayer relief, We do try it for some clients where that is true, but it doesn't always work. So I'm going to give you two examples, one where it didn't work and one where it did. We had a client who was a business client. So they had a small business. They ran their business out of their basement. Actually, their home was in their basement. Their home and their business was in a basement apartment. The entire basement flooded. They lost all of their business income for the year and all of their business records, as well as their home, which they were dealing with at the same time. The CRA, in the meantime, audited them for all their business deductions that they had claimed in the last 3 years. And they said, we had all those receipts, but we just had a flood and they're all destroyed and we can't reproduce them all. They applied for taxpayer relief. They said it's extraordinary circumstances. The CRA said, too bad, you're responsible for keeping your receipts. They were not granted taxpayer relief in that scenario. Okay, so I would say those were extraordinary circumstances. The CRA said, you should have done a better job of storing your receipts. That was it. We ran out of options unless they wanted to go to court, and they didn't have the money to go to court, so that was it. All right, we had a different one. So this is one that worked. We had a taxpayer who went to the bank and purchased an investment, and she said, I don't have room, don't put in a TFSA. I don't want a TFSA, I just want a regular investment. The bank put in a TFSA. She found out they put in a TFSA, went to the bank and said, you need to take this out. I'm going to have penalties. I'm going to have a TFSA overpayment. You have to take it out. And the bank said, oh, sorry, we've corrected it, don't worry. And they didn't take it out. And it was still in. And in the meantime, while she's negotiating with the bank to try to get them to fix the thing the bank did that she told them not to do, and she had documentation on this. She had letters, she had a record of her phone calls, she had the statements, all of the things. She kept going to the bank, and they kept not taking it out, and it kept being in there. And then the CRA said, you have a penalty for T1 OBPs, for TFSA overpayment. And she went to taxpayer relief and said, I really tried very hard not to overcontribute to my TFSA. The bank is not helping me. You deal with the bank. And the CRA called the bank, and the bank was just as helpful. And at the end of the day, the CRA said, we're not going to charge you for overcontributing because this was out of your control. So they were successful on the taxpayer relief, and they were not charged the penalties for the TFSA overcontribution because they really, really did not want it, and they had tried very hard, and it was not their fault. So that was one that was successful. And that was an interesting one because it doesn't technically fall under the rules. They weren't prevented from filing, and the penalty wasn't because of the CRA's error, but in that case, the CRA did say, this is an extraordinary circumstance. You should not be responsible for those penalties. So it exists. You can try it. Remember, there are lots of times when you try it and you don't get it. So it's not a catch-all for everything that happens. All right, that's taxpayer relief. You can do that application online as well. So this can all be done. Voluntary disclosure is the only one you have to do by paper right now. I'm going to wait to see if they change that in the future. I hope they do, because let me tell you, when I do voluntary disclosure for my clients, I print hundreds of pages, and I have to get this big, lumpy envelope, and I have to send it registered mail, and it's expensive. So voluntary disclosure, we're hoping they'll make that one online as well. But for now, taxpayer relief you can do online. All right, refunds. If you owe money, you can get a refund for 10 years back, but you cannot make refunds for overpayments of CPP more than 4 years or EI more than 3 years. Okay. Elections, we've talked about elections. The ones we know how to do in this course will be things like split pension. It will be things like principal residence exemption. If you want to elect to make that exempt, these are elections. There are more than 120 that exist in the Income Tax Act. Most of them are in more senior courses. So when we get into capital gains, we have a number of things we can elect to do. I think the only other election that is in this course that you should remember, you can elect to do something with your dividend income. If you're the lower income earner and you have dividend income, what can you elect to do with your dividends? Pop quiz on Chapter 7. What option do you have with your dividend income if you're the lower income spouse? You can choose to give it to the higher income person, provided it either creates or increases a spousal amount for you. That's an election. If you didn't do it and you want to go back and you want to fix it, you can, but there may be penalties. So the late penalties for election are a percentage of the difference to a maximum of $8,000 per year. Okay, so you'll have to see what the penalty is for the election that you're trying to ask for, and then only do the adjustment for the election if it's worth more than the penalty is going to be, because there's no point in saving them a little bit of tax money if it's going to cost them a large penalty. All right. That is this chapter. That gives us just enough time to do the review problem, so we're going to do the review problem together for this chapter as well. If you haven't done this one, do your best to follow along, but we're going to do it together in class. So hopefully everyone has taken a look at the review problem at the end of chapter 15. I'm going to find it now. It's way down at the end. We have a scenario that you will find after you've taken this course is going to feel very, you're going to feel very seen when you see this one. You're going to have a friend. After you've done this course, when people find out you've taken a tax course and you've passed it, you've gotten a good mark, everyone's going to ask you for tax advice in the same way that if you go to medical school and you go to a cocktail party, everyone starts asking you to look at their mole or whatever weird thing. So we get this in tax all the time. People find out you know about tax, they start asking you about tax. So here we have Ashley Jones. Ashley Jones lived in New Brunswick in 2021. So we're going to be doing New Brunswick forms, okay? She worked as counter clerk. We have some information about her. She has now moved to Manitoba. She is your friend. She did her own tax return. You'll find out quickly from looking at it that she did it by hand. She mailed it to the CRA. She hasn't gotten her notice of assessment. She found out you did the tax course and she said, look, can you take a look at this? Because I'm like really, it's my first time doing a tax return. I think I did a really good job, but why don't you take a look and tell me what you think? So we're going to take a look and we're going to tell her what we think. All right. I want you to notice a few things. We have a T4. We have some tips. She has 2 children. She's divorced. She has sole custody, is not receiving any support. She has received Canada Child Benefit. She had some child care during the year which she needed to go to work. She has a receipt for the child care. She has some medical receipts. She has dental work. She has glasses, prescription drugs, and she has a receipt for non-prescription herbs and medicines for an allergy symptom. So over-the-counter stuff. All right. So she's mailed it. She sent it off. We're going to take a look at it line by line, and we're going to decide how she did. So we have some workers' comp. I'm going to assume her first pages are correct. I can't fix that. She has updated it with the new mailing address, which is good. She's going to get her notice of assessment here in Manitoba now that she's here. But her province or territory was New Brunswick, so we need to think about New Brunswick forms. She said yes and no. And then we get to the income page. So what I'm going to get you to do, I'm going to annotate here. Allow everyone to annotate. And I would like you, just going to scroll this, actually, hang on, I'm going to scroll it down just a little bit because I want to go down just a bit further. I would like you to tell me from here what is missing. What do we have to fix? All right, we've all identified that tips is a problem. If you said tips, you are correct. We have to add some tips in for her. Okay. That's the only thing I found on this page. If you found something else, let me know. But that was the main income one. We need tips on line 10400. Okay. I'm going to stop annotating there. I'm going to go down a little bit more. You're going to notice she put her workers' compensation in, which is good. I'm going to go down to the next page. And I'm going to ask you to tell me on the part you can see on the screen, what are we missing on this page? Aha, child care expenses. Very good. What else? I see one more thing. Let's see if you see it. Has anyone found the other problem? Not so far. There we go. CPP enhanced. She did not put a CPP enhanced deduction on. She probably didn't file a Schedule 8. So, what do you think she probably did with the CPP contributions from her tax slip? She probably put them all on the non-refundable credit. She's not going to get the deduction. They're just going to adjust the non-refundable credit for her. So that's the problem. We're missing some stuff there. Okay, we're going to stop annotating there. Going to go down even further to the next page. And let's go from here. I think that'll give you enough. Let's see which things that you can see on the screen that we are missing now. Workers' comp. She did not take her workers' comp out. She put it in, but she didn't take it out. Good. What else? If you go way down to the bottom of the page, eligible dependent. She hasn't done a Schedule 5. Is she eligible for eligible dependent? She is a single mom. She has sole custody. Her kids are with her. They have no income. That's a big credit that she missed. We're going to be able to fix her return and make a big difference if we do a Schedule 5 for her. Good. I'm going to stop annotating there. I'm going to go down to the next page. Okay, let's see if we can find some mistakes on this page. She's missed the Canada employment amount. Very good. They won't give it to her if she doesn't ask for it. What else? CPP, she's claimed too much. Now, the CPP, the CRA will fix. They will fix the CPP by reducing it. They will not add the enhanced portion in if she doesn't file a Schedule 8. So we're going to have to fix that number for her. Medical expenses. Good. What was the problem with her medical expenses? You are correct. What was the issue? She included some stuff that's not on the list. The herbal non-prescription things are not allowed, so we have to take those off. All right, that's everything I found on this page. Again, if you found something else that I've missed, let me know. I'm not infallible, and I did this at 11 o'clock last night. I had everything else sorted out, and I thought, I think we're going to have time to do this, so I want to do it today. All right, so let's go down to the next one. See if there's anything on this page we have to worry about. What do we think? All right, so it is going to change her numbers here, but we don't have to add that on the adjustment because the CRA will fix those based on everything else we do. But you are correct. It's going to change both of her taxes owing federal and provincial. And we're going to go down one more page. Now, she did calculate a refund for herself. We know the numbers are going to change because we're changing a lot of things. What else is she missing? What else is wrong? Now, there's a tricky one on here. Oh, good, you did catch it. Total income tax. She put the wrong number from her box 22. She probably had a typo. We have to fix that. What else? I can think of two more things. Let's see if you can. Refundable medical expense. Good. Her income is low. She had medical expenses. Refundable medical expense supplement. If we apply for it, she's going to get it. What else? Canada Workers Benefit. Good. Canada Workers Benefit, yes. So Canada Workers Benefit, if we apply for it, she will qualify for that. We should apply for it. She's a single parent. She has eligible dependents. And she has low income, but she has income over $3,500. Now, provincial credits, you have to look up. So if you don't know how to do a New Brunswick return, I haven't done a New Brunswick return. That one you're going to look up. If you look that one up, you're going to find that there are no refundable credits in New Brunswick. But it's good to check because she didn't know what she was doing. So you're going to take a minute and look at the provincial forms for New Brunswick and see if they don't have an NB 479, which they don't, there won't be any refundable credits there, but it's good to check. So we're going to have to change some things. If you're going to file this adjustment for her, what are all of the forms and documents that you're going to need to make this adjustment go through? We need childcare receipts, and to go with the childcare receipts, what form is going to go with those? A T778, very good. I knew which one you meant. What else? This is going to be a paper adjustment, by the way, because there's a lot of stuff. I would just do this one. Log of her tips, we don't need to include, because if she's adding income, they'll accept whatever number she puts. But it is good for her to have one, so we want to tell her to make a log in future. Good. What else? Medical receipts. Very good. She's claimed them. We're going to change them. Make sure you include them, or they'll allow 0. What else? A Schedule 6, which is our Canada Workers Benefit. If you don't file the schedule, they won't get it. Very good. Do we need a Schedule 7? Did she have RSPs? No, but we do need a Schedule 8. Plus, where do we get the numbers for the Schedule 8 from? We have to prove whatever we put on the Schedule 8. Where do we get those numbers from? Plus the T4. I know they have the T4, but the person sitting in the little cubicle doing the adjustment doesn't have it unless you put it in front of them. So put it in front of them. Very good. What else? There's another schedule. If we're going to do eligible dependent, what schedule do we need? A Schedule 5. She won't need any supporting documentation for that one. She already has her custody on file. They're going to know that she has the children. She just needs to fill out a Schedule 5. Okay. What else? Remember, we're changing workers' comp. We want to deduct the workers' compensation portion. What do we need to prove that she had workers' compensation? C5007. Send that one in too. I know they have it. Send it anyway. All right. That's everything I could think of. That's what I would include with this adjustment. And for that reason, I would do this adjustment probably paper, because you're changing so many things. Now, I might change my mind if I find out more information about how we do, how they do this express adjustment. If I think the express adjustment is going to go through quickly with medical receipts and childcare on it, in that case, I might do it. Okay. I suspect it won't be things that require receipts. It will be just schedules and line numbers with slips that you already have. Those ones I think will go through quickly. I would probably do this one on paper and wait for it to come in. She's already gotten a refund. She'll get the rest of her refund when the adjustment goes through. Is it going to be a significant difference? Is she going to get a lot more money back or just a little bit? She's going to get a ton back. Eligible dependent, Canada Workers Benefit, refundable medical expense supplement. We did forget we have to do a federal worksheet for the refundable medical expense supplement. We need the worksheet for that, so we're going to fill one of those out. All right. I think she's going to get a lot of money back. And if we're changing her income because there were deductions on there, it might also change her Canada Child Benefit. And Brittany, good. She missed things that the CRA will not give her if we don't ask. So if she doesn't ask for this, the CRA will just adjust the amount of, what's the word that I want to say, CCP contributions. They'll just adjust the non-refundable portion, and that's the only thing they'll fix for her. They won't fix anything else if we don't ask. So There you go. If you're curious and you want to practice doing a T1 adjustment, you now know what you need to do. You can do a T1 adjustment for this particular person as practice. If you want, you can send it to me and I will review it for you and tell you how you did. The tricky thing for adjustments is identifying what you need to change and the documents. If you identify what you need to change in the documents, the rest of the form is easy. Good. That's the course from a theory perspective. That's everything that you need to know for tax theory for this course. So we have 10 minutes left in class. This is a really good time for review. If you have questions, now is the time to ask me. If you want to look at old chapter review problems, let me know. We've been doing reviews as we go. You'll notice I ask you questions to remind you about old things you may have forgotten. I've also given everyone some summary pages, so make sure you have them. You should have received an RRSP summary. It's a 2-page summary with everything in one place about RRSPs that we've taught you in this course. The transfers were a little tricky. I do recommend going back and watching the recording for RRSP transfers, just because it's kind of messy and it was done a little bit more clearly on the recording than it was done for this class. So go back and watch that recording as well. You've also got a summary for personal credits, which you got last class. Make sure you have that. It may help you to have, and if you find that format useful, I recommend doing the same for your provincial personal credits as well. So have a table, have a chart that summarizes it for you as a quick reference guide. And Brittany, pensions, you need to do everything from pensions again. Again, as you're studying, you're going to have extra time. We don't have a class on Monday. I will still be checking my emails. Send me questions. Send me review problems. Ask me what you're doing. Pensions, I want you to refer to your facts and figures book. There's a really nice table that's going to help you with your pension things. Other things to remember from pensions, CCP, OAS, never split them. They do not qualify for the pension income amount. Other pension income, anything on the table or chart from facts and figures. If the chart says it qualifies for the pension income amount, it does. If it qualifies for the pension income amount, it can be split. Helene, good. U.S. pension calculations. How do we do it? Convert it to Canadian. So you take the exchange rate for the year, convert it to Canadian. That goes on line 11500 or no 11900, whichever the line is for pension income, somewhere up there. Pretty sure it's 11. I don't remember. I'm going to go look it up. Told you, I don't have all the line numbers memorized, just the ones I'm using today. So pension income goes on line 11500. Good, I was right the first time. And then you're going to take 15% of whatever that is, and you're going to deduct it. And when you deduct it, you're going to take it off as a deduction because it is not taxable. Then, when you do the pension income amount, the portion that's eligible for the pension income amount is the total minus the deduction. And if you want to see that, the review problem that does it in a really nice format, I'm going to pull up my DT Max here if I can find it, is our Edmondson case. So if I go back to the Edmondson family, and I take a look at their pension income, I'm going to go down to the worksheet for this. They have a foreign pension. It was $1,000 US, which is $1,250, $350 Canadian, goes on line 11500. And then when I'm calculating the deduction goes on line 25600. It's 15%. So the pension split is all of it minus the exempt portion. Okay? 50% is rare. Sometimes it's 50%, but they have to have had their pension for a very, very long time, and they have to have been in Canada the entire time as well. I used to see them when I first started doing tax. I had 1 or 2. I haven't seen them recently because taxpayers have to be quite elderly to qualify, and most of the time they would have started receiving their pension in the U.S. and then moved to Canada, and then they don't qualify for the 50%. It's just 15%. And Helene, the tax credit is 15% of the gross. It goes on line 25600. Okay. So think of it as a deduction. Brittany, good question. If you're going to work for the company, you have to be set up for Rep-A-Client by kind of January, February. So what I recommend is if you have filed a previous return and you've never signed up for my account, do that now. Get signed up for my account. As long as you're signed up for my account, we will be able to identify your Rep ID number and get you set up from there. So we'll help you with that, the Rep ID portion of it, when you do great training. But make sure you have filed a return and make sure you're signed up for my account, and then you're good to go from there. All right. We are going to be sending out recruitment letters. If you haven't already gotten it, make sure you get one by the end of the week. If you don't have an email by the end of the week, get in touch with me because I can follow up and make sure you get one. And Saskia, if you're a prior, you already have Represent a Client. And if you're a prior, you don't need to go to the recruitment because you probably will already have been contacted for employment. So those of us who work for H&R Block, we've already recently done our interviews for the next year where they kind of review how we did and where we want to work for next year, how many hours we want to do, all of that. Not related to course, how long before you can pursue learning for U.S. filing? So you have to finish the basic levels first. We have 4 levels, so 1, 2, 3, and 4. Usually, most people will do level 1 twice before they go on. It depends on your experience and how many returns you've done and how comfortable you are with the material. Most people find that after they've done level 1, then they work for a year. Then when they do level 1 a second time, they catch everything that they didn't get the first time because you've all discovered there's a lot in this course. So most people will do level 1 twice, and then you can start doing the upper level years. The fastest that you would do it would be after 4 years, you finish your business course. The next one, you have the option to branch out and do any career path you want to go. So if you choose U.S., you'll do U.S. there. Yeah. And actually, we right now only have 1 U.S. specialist in H&R Block. We have 1 person who does U.S. returns here. So I'm sure the company would be very happy to have a second one. That person is very busy. So if I have clients who need American returns done, it is Debbie. Absolutely. She's wonderful and lovely and overwhelmed. And so if you have a client who needs a U.S. return, you do need to make sure that they get their information in fairly early so she has time to get to it. Those of us who get into the higher specialties, we are in short supply. So my specialty is corporate and complex business returns and complex residency situations. I get a lot of people who need me. Starting in February, I'm busy right away. And then, so the other career paths we have sort of my side of things, which is going more in the business direction, and then we have corporate special or Quebec specialists as well. Complex residency issues are people who are deemed residents as opposed to factual residents. It's people coming into the country, people going out of the country, people being here part-time, people who have come from other countries where we don't have a tax treaty or a country where we do have a tax treaty, but they have a lot of assets in other countries. That's kind of what I do. So determining if you are resident in Canada, if it's a complicated issue, my job is to try to figure that out for you. If it's an easy one, you guys can do it. So if they're in Canada and you know which province they're in, it's basic residency. If it gets a little bit messy, it lands on my desk. So I do non-resident returns, I do part-year returns, immigrant returns, emigrant returns. I deal with assets, and I do businesses in other countries as well. And I do deceased. Sorry, that's the other one I do. I forgot that I do deceased returns. I do deceased and trusts as well. I move around, but most recently I've been in 857 Portage. And I have my email, so people find me from all over. I still have students that I taught 5 years ago who will contact me in the middle and say, I've got something complicated. And I would like to ask for your opinion because you were my teacher and you know things. I will say if you're in an office, ask the people around you. They're great. Senior associates are usually very helpful because we want all of our junior associates to be experts so that they can help the next group coming up as well. But you have people to reach out to during the tax year in your office through Block Signal and also other offices as well. You can call and say, there's no one in this office who does this, but we have a question. Soheen, you couldn't join the upcoming employment presentation. Is it possible you get the presentation information? Do you mean the recording we watched in this class, or do you mean the live on-site recruitment? So the recording in this class that we watched is going to be added to Inkling. I'm not sure exactly when, but in the next couple of days, if you missed the video or if the audio wasn't working or it was fuzzy, they're going to post that for you. The in-person recruitment, what you want to do is contact the district manager, which is Carl Kopp, and contact him and say, I'd like to come to recruitment, but I can't make that day. Is there an alternative? And they'll set that up for you. Okay, and I'll type his name in here as well. There you go. So you have his contact information. So yeah, if you have questions about that, he will be the one doing the interviews. If you want to work for H&R Block, they do want you to go. If you're a prior, no, but if you're a prior, you should be getting in touch with Carl or Shelley just to say, I'm a prior and I'd like to come back to work. Make sure that they know that you're still interested in coming. Yeah, and again, Brittany, if you haven't gotten it yet, wait till the end of the week. If by the end of the week you still haven't gotten it, then let me know and I'll make sure that you do. It may be if you're in a franchise area that you're not going to get it. So if you're in a franchise area, you should be getting it from your local office, in which case call your local office, let them know I'm doing the course and I want to work. What do I have to do? And Helene, good point, check your spam, because some of these things just get redirected to other places. All right, we are over time. So I'm going to say goodbye there, but I will stick around at the end of class for more questions.